All right. Happy June 15th, everybody, aka FOMC rate decision. And yeah, we're getting live here. We've got a rate decision at 2 p.m. That's where all the Fed board governors meet. And then we also have a 2:30 press conference with J Pow. Or maybe a 2 p.m. press conference with J Pow. But we'll have that live. And yeah, we have BApig math going on right here. Big trading day amongst us. Really big trading week. And yeah, we're checking out some things in traditional markets, Bitcoin, currencies, interest rates, anything else. Really all of it. We got Bitcoin right here. And what else can we can run through? Also a kind of a market check too for different assets. And yeah, so come join and hang out and help contribute to the to us learning about the financial markets. We got the great math of BApig right here on screen, and yeah, really just this type of perspective is one that not a lot of people really hold in finance right now, but they will hold just looking at things like HVP here and HVE. So I've got a volatility panel on the left right here. I've got a just kind of price and returns panel right here, or pane, whatever you want to call them. We were using TradingView software, and yeah, so over here I've kind of got more returns and mean type indicators as well. Entropy again, different setting on entropy to study the entropy of drift as opposed to the entropy of volatility or the tails really. And then also we've got a pane right here with some means and some directional indicators and z-scores of different means and things like that. All provided by BApig. Their service is grossly undervalued. It's really something that if you want to look back at anything, really, like if you want to look at the U.S. 2-year yield, right, and it's been kind of mooning, so to speak. You can look at it over here, and this is the great work of Pig and the gang over here at BApig, and you can see volatility flash letting us know that returns here are smaller or less volatile than other returns in the past 1,000 sampling, and yes, there are a lot of flashes right here, but looking back over here, yeah, that there's but just looking at that right there, if we want to go to the triple Q, or actually if I'm going to be doing a 4-hour study, then I'll prefer to do that on the NASDAQ futures. But we can go back over here. I'm pretty sure it was this 4-hour HVP flash right here. No, that wasn't where. It was a 6-hour HVP flash right here. And then if you want to look at it on HVE, we can go to the hourly. In the hourly, there was a HVP flash right here letting us know that volatility is low and then volatility expansion. That indicator right there is free. Really, probably shouldn't be. Really next level. But that's for BApig. It's really more on the rudimentary, if I should say. But I'm just somebody who's been using these indicators and have made some profits, have made some losses. More so the losses are my own fault. But yeah, last FOMC rate decision, I was short, and it was a bloodbath. But that was kind of more of a just kind of a YOLO type trade, but not really too well thought about. But hopefully we can kind of profit today. Yeah, I did get a nice short delta in on that HVP flash, and it did pay. I wish I was a little bit more kind of patient with that with those deltas, but it was pretty large relative to my account size. So kind of had to take some profit. But I'll check what's going on over here in the chat. All right, still waiting on some peeps to join here, but that's all good. We'll be live, so keep it going. All right, so let's do a dive on the Nasdaq and kind of see about that, and we can also set up a so I have this chart set up right here, and this has the Nasdaq, which is the triple Q right here. That's the ETF exposure to the Nasdaq 100, and then we have Bitcoin, of course, biggest crypto, and then of course we have Euro dollar futures. Shout out Vlad, and more so Vlad, he kind of showed me about these Euro dollar futures guys, or these Euro dollar university, and it's really eye-opening in terms of the way that interest rates are kind of determined by the market, and learn about that. And if you kind of get to looking at this, my bad for kind of being a little hostile in the Discord and stuff like that. I get what you're trying to explain there, and it really opened up my eyes. So the Discord over, I pour one out with Bali on Discord. POWB is a great Discord if you have the opportunity to join. There's a lot of great conversations and stuff like that, and grateful to be there. And my bad for kind of messing up the vibes a little bit, but hopefully I can kind of help bring those back or whatever. I've been on a little bit of a hiatus. Shout out Encode for kind of saying, but it was more so that I just needed to kind of take some time to realign, and streaming while trading is a art or really a science in and of itself. Being able to kind of keep up with other people while you're trying to do some deep work is, but realistically, your trades shouldn't be like a minute-to-minute basis type thing. It should be more of a day-to-day, week-to-week, where you can manage your exposure. So like what I did last FOMC rate decision, I shorted like one micro Nasdaq future, which doesn't sound big, and it really isn't that big, but I'm just kind of starting out with this account here. So that's exposure to $25,000 worth of Nasdaq stock. So when you see that Nasdaq ticker right here, $11,518, well, it's actually double that in terms of the exposure. You're getting exposure to roughly about 80 triple Q deltas, or 80 triple Q shares, which is pretty sizable for a smaller account, using that margining. Shout out Michael Saylor. He's having to add some more collateral on his margin, but yeah, using capital efficiency, whether it's in the options market, futures market, I'm all about that, and being able to properly hedge and things like that is something that I'm learning, and hopefully that we can learn together and help kind of spot occurrences and say, hey dog, why do you have naked risk open on the Nasdaq or whatever, and just going back and forth, which is what this community is all about. BApig live, thanks for joining. So let's see what's up. All right, so on this hourly right here, so if we're going to be playing something real short term, maybe an hourly on the futures, or like a 26-minute on the equity version. And the only reason why I'm changing those time frames is just because the Nasdaq futures, they trade 6 days a week and 23 hours a day. as opposed to the ETF. It only trades for 8 hours a day, or 6.5 hours a day, I should say. But it's not really too much of a big difference. But you can see like over here, like on a historical volatility standpoint, we're low right here. VRT right here, this is a market state indicator. Really the presence of a random walk, or how the market is kind of is it outside of a random walk, which is outside of these yellow lines, or is it inside of a random walk? So just kind of a randomness measure in a sense. Market state, which is very useful, because you can see in times like right here, this is when the market is inefficient. The market is not in a random walk. So let's check that out. So kind of coming through here. So when we see that blue coloring, and when we see it significantly above that yellow line, then that's telling us that the market is in a state of trend, and it is not in a random walk, which is a just another way to view returns. And that's really what all of this is just you're just putting a frame of reference around returns, which is something that is random in a sense, less random than price, but so we're putting this frame of reference around returns, and we're able to make decisions about the expected returns based off of a lot of these calculations. So this is a much more mathematical way to view the markets than just saying, oh, J Pow is going to keep things at 50 basis points, and that's going to be leading to positive returns. Well, there's not a lot of math. There's hardly any math really behind that, unless you're doing some type of more analytical study. But a lot of traders, that's what I'll notice, is that they'll say, oh, well, this is going to happen, so I'm gonna bet this way or that way, which isn't really the best way to be doing things in 2022 with computers that are very good at calculating things or whatever. But that's enough of my spiel there. But yeah, so looking at vol here, vol is low. So let's put this over. So this is on the QCV. That's on 100. So it's looking like that this variation, that there might be a. So if there's more variation in the mean, then that could be correlated with positive returns. Okay, that's I mean the last Fed meeting, there was an increase in variation, and it was a rug pull to the upside, like, to put it in the words of Ankh or Bali. It was a volatility expansion that was with positive returns. We can go back on that and check that out. That last rip. During that May FOMC meeting. Yeah, I got. Hey, how we doing, Chubb? Unk. Yeah, I know. We definitely got to get the vibes higher than this. But yeah, let's check out what the financiers are saying. Not yet, but we'll definitely switch over to that at some point. And I'll probably just keep Bloomberg on and just roll through different charts. But ahead of the Fed, you definitely have to have the old ZQ up. So instead of Bitcoin, I'm probably just gonna put ZQ. 30-day Fed funds futures. And okay, so if you see 30-day Fed funds futures, if they're increasing, then that means the yield is decreasing. So what people would say is that, okay, well, we don't even really need to go into that. We can just so the reason why this price, this is I don't know, like this is a futures right here, a futures price. So you could kind of look at that as the bond price in a sense. I don't have a ton of experience trading 30-day Fed funds futures, but all I do know is that when this future decreases in price, then that's an expectation that the Fed is going to increase rates by more relative to that decrease in the future. So we saw this on the 13th of June, where there was a huge decrease in the Fed funds futures, and that's indicative of the 25 extra basis points that they're now factoring in, which would be a 75 basis point increase, or 0.75% increase. Okay, so let's get some mutual information up here. Mutual information is another BApig special. I mean, people would probably charge you an arm and a leg for this thing if you were looking for just this indicator. Well, it's really just a measure of mutual dependence between two different assets, but nobody's really even talking about this, let alone coding it. All right, let's see what we can take off of our screen here. I guess the column, and then we can get our mutual information on, and this will tell us the mutual dependence of whatever asset we want. Right now, that's the S&P 500. But the only thing is that the way the bond price and the bond yield work, that may not be the best. We might want to just go Fed funds for this one. I could maybe invert the chart, but so seeing that normalized mutual information, so they're saying that there's not a huge amount of mutual information between those two assets. And then we can look at something like the triple Q if we want, versus the S&P 500 or NQ. And that normalized mutual information. So you saw 0.05 for the Fed funds, and then 0.38, 0.4, so orders of magnitude higher, and looking at information adjusted correlation of 0.89, so those assets move together more or less, but and then looking at the information adjusted beta too, so S&P's move up by 1%, then the Nasdaq's going to move up by 1.26%. That's a really great measure right there, if you're trying to hedge your deltas or whatever. Another BApig special right there. Thanks again for joining BApig Live. Got the elevator music going on in the background, just trying to chill out here before we get some feenance action with probably Bloomberg playing, and then we'll switch over from Bloomberg and we'll go over to J Pow on the mic in front of reporters asking questions, the financial media, so it'll be a good day. And I think that there's going to be some opportunity. It looks like that there's going to be a vol expansion on the Nasdaq. So let's check. Let's kind of continue to look at that. we got some craziness going on in that chat. Love it, guys. If you guys need anything, let me know. Yeah, I will be the purveyor of the fives in the stream here. And hopefully, probabilistically, let's make some fucking money today, boys, and females in the crowd, hopefully, or in the community. I love these guys that they send on Bloomberg. I think they purposely just send the biggest idiots that they have. Which is maybe why BApig sent me here. And I do this kind of, I would be doing kind of this anyways if I weren't streaming. So maybe not with this type of setup right here. Like, I'm not going to be using this to make trading decisions. Well, I could use this to make trading decisions, but I'm more kind of focused in on one asset. But today's a special day with the FOMC. I think they're talking Eurodollar though on Bloomberg. Yeah, I think they're talking Eurodollar rate cuts going in on that. But Eurodollar University, Vlad put me on to that, and it is eye-opening about the credit markets and just learning about the really how these markets are being plumbed, and with liquidity, and how banks rely on other banks, and the level of yield that they require on different loans, and it's really is a great resource. I was kind of going back and forth with Vlad about whether or not the Fed funds rate really matters, or the Fed funds rate is just following what's going on in the overnight market, and I'm still looking into that, but I don't know really how much you can discount the Fed funds rate, but that's not what this is all about, really. Like, that's just really esoteric compared to what this really, like, this chart right here will give you everything that you really need to know, and then that other stuff is just kind of supplemental, I guess, complement, but whatever. So let's check out. Yeah, so let me check. So we got some vol increasing right here, and then we also have entropy increase right here. So entropy's high on this hourly time frame. That's telling me that randomness is relatively high. And then we also have our SSR right here. So this is telling me the self-similarity returns is relatively low, or it's actually pretty low, considering that this band right here represents the 2.5% value in the distribution. So that is something of note right there. And I was monitoring on a lot of the risk assets, people would call risk assets, such as Bitcoin and NASDAQ, and just looking at the volatility in the mean. This is the mean pro by BApig, nothing like it. Basically mean of returns in a sense, but with some smoothing going on, and some triple exponential type of smoothing and stuff like that, which really just helps to get a quicker read on things. But looking at variation in that, seeing how variation was rather high on a 12-hour. Last time we saw things this high was 21st of January, and then also September, and then you can look at things like in relation to COVID right over here, where we saw like a 1.0, but we can also look at in relation to the EMA. So I have 250 candlesticks of calculation for that EMA on variation. If I want to increase to like about 500, so make it a longer term mean, then looking at that and saying, okay, we're well above it, and the red also indicates that the variation in the mean is in an outlier state, but what's to say that it's not a 3 standard deviation move instead of a 2 standard deviation move, which is exponentially different, as Unk will let you know, or Bali. So that's something I've been looking at, and just looking for a variation to decrease, and a lot of these variation decreases have been the variation decreases are in a frame of positive returns, really, and then variation expansions are variation expansions are connected with negative returns, from what I've seen here, and that just makes sense in terms of large indices. But Unk, if you're trying to hop on or anything, let me know. I'll get it set up over in Discord. Hey. You know, looking at the Discord, somebody was like, "Oh, you got to watch out. Bali is in the mood to hit up some Twitch streamers, because there's so many bullshit Twitch streamers, and I don't even really consider myself a Twitch streamer. I just use it as a medium to be able to get this type of stuff, get BApig out there, and I like it. I'm not scared to get into a dialogue about some markets and stuff like that. Doesn't really matter to me. Well, it does matter to me, actually. I encourage it. If you got some shit to talk, pull it up. You know, I'm cool with making myself better. I'm positive, negative criticism. I mean, we're talking about charts here, and we're talking about trading. So let's keep things into perspective, really. And kind of look at things and say, okay, like a lot of these people, it's a totally different level, especially guys like Unk. I mean, they're out here. They're managing some notional. You know, I'm over here, and I'm scalping the stick 60 at $200 in buying power. So, but. Yeah, so looking at this variation on the 12-hour, we are in a deep state of mean reversion, huh? I didn't really... Well, I've been using this on different sample sizes, but looking at a state of mean reversion like that, I haven't seen that. But if I put on 100, I think, playing around with those Hurst settings. But Hurst exponent letting you know about the size of returns and some degree of autocorrelation. I'm not gonna pretend like I knew about autocorrelation before coming to BApig, or triple exponential smoothing or anything like that. A little bit here and there, but that's what this whole community really brings to light is the math of finance. So we got the mom right there. Mom hitting those bands, and those bands are for the past 1,000 candles. Those bands are showing that we are in a outlier in terms of returns. Looking at that. And then looking at the mean pro right here. Mean pro is one of my favorites. So the difference, why do I have 2 mean pros up? I've got one mean pro that's just on 30 look back, and then I've got another mean pro that's on 1,000. To take into account, build like a larger sample size model, in a sense. So looking at this right here, this histogram. So this yellow line right here is a 2.5% probability of returns the mean of returns reaching that value. So this right here. So 2.5% probability right there on the 12 hour from the past 1,000 candles. So building up that model, hopefully. Yep, FOMC rate decision at 2 p.m. So all right, so 2:30 press conference. So it'll be cool to be able to see in real time. All right, so we got the SOFR too. That's the there's like this overnight financing rate, secured overnight financing rate. That is important, quote unquote. I think it definitely is. But so being able to look at these in real time with the rate decision here, seeing if any of these guys have any insider information on any of this, making some plays maybe before the public starts gets their hands on it. But going back to the mean of returns, so mean of returns right here. So this is the mean of the mean of returns, and so denoted by this white step line, and then there's the standard deviations around that mean, and so this is the first standard deviation right here. So 68% of values should be in between these two bands right here, or 34% should be within this area right here, and then 95% of returns values should be in between these two yellow lines. Let me get this set up a little bit better so peeps can see that 2SD. That 2SD right there. Oh, and that's what. Alright, so 95% of mean values should be within 0.10 and 0.09 or 0.08 on the NASDAQ. So you can turn on your labels if you want, just to be able to make sense of it all. So mean 3SD right here, so 99.7% of values should be. So you see this right here. This is the type of stuff to look for, is seeing values outside of that. And how'd that do? Very well. So this is just kind of a visual representation of kurtosis, another word that I did not know before getting into the BApig world. My business degree did not really talk about kurtosis, when probably should have been one of the fundamentals, just in business alone. But yeah, looking at that, so outside of the third SD right there for the mean of returns, and then coming back up, going back outside right there, coming back in. So that was a little bit more of a normalization right there on the March. So people will talk about all this stuff, like, like if the Fed does this, Fed does that, but looking at the mean of returns might just alleviate having to listen to any of that financial jargon. Just being able to put that up there and saying, okay, well, over here there's a 0.15% chance, or 0.15% of values are going to be outside of here, and 99.7% of values are going to be inside of here. With confidence in this model, right? So then, all right, well, I'll be the contrarian right there. So all these people want to be contrarian traders, but they're being contrarian traders on price, usually not on returns. BApig is here to save the day with that. So thanks again for joining BApig Live here. Let's see. We got Tom Keene coming up here, so might have to turn myself down and turn up some of the outside noise, just for more so entertainment purposes. Although watching me lose money live is somewhat entertaining. Watch me make money live might even be more entertaining, but we'll see. I'm scalping a little Bitcoin right now, and Henry Hawk, yeah, mucho dolores, but I'm not really scalping anything right now, but it looks like a NASDAQ scalp is in the cards for getting on the long side of things, but that's to be determined. But I mean, I can scalp anything really. I can go in. I can scalp crude oil if I wanted to. I can do 2-year yields. But there's a lot that's available. Probably use this chart as my fuck around chart. But yeah, if you're scalping anything, feel free to reach out and kind of say, hey, this is what I'm seeing here. But again, shout out BApig, BApigindicator.com, and join the freaking Discord. Contribute, put your opinion out there, keep the vibes high, and yeah, just know that you guys that we're on the kind of the cutting edge of retail finance, but yeah, pretty cool. So thank you for all BApig really, and you guys kind of coming in and making this happen. But yeah, nothing specific right now. I've got like an SCCX contract open. That's the Tastyworks future. I've got some BITO Delta in the money right here. I'm actually down $80 on that today, but nothing too large here. Nothing like what I consider a scalp is something low time frame, higher leverage, and just kind of in and out. But yeah, of course, that's the definition of a scalp. But not in anything yet, just like that. But which really got to be able to be okay with taking some hits like that. But just from the amount of leverage, if it's not right for your account, and if you're new to this, definitely not the move to have naked leveraged risk. Now, defined leveraged risk is a little bit of a different story. But all right, so we can go back to the cues here, and it's about 140. All right, we got TD Securities Global Head of Rate Strategy coming in hot here. Priya Misra, 17 minutes, 25 seconds FOMC decision here. So let's check out what's moving here. All right, so anytime you see that these futures right here are increasing, then that means the yields are going down. If yields are going down, then people will make a connection that risk appetite will be increased, or that there'll be more people looking to put on risk relative to fixed income, or just interest rates in general. So we've got these three right here. So if you see prices going up, then most likely that will be correlated with triple Q looking higher, and we can also do a study on that too. And the mutual information of all these assets are low, but I wouldn't trade like that. I definitely wouldn't trade like that. But that's just the type of traditional way of thinking about it, is seeing these futures going higher, meaning the yield is going lower, making fixed income less desirable. I guess that's where it gets kind of speculative, but it just makes sense from a intuitive standpoint. And then so this would be your risk asset, so the triple Q. So if you see these things go higher, then possibly the triple Q could also increase in its returns. And if you see these things going lower, then you'll see triple Q possibly decrease in price, but none of those are definites. So that caught my eye right there, that 30-minute on the 30-day Fed funds futures. Thought I was seeing... Okay, yeah. So on the 26-minute, actually, we're seeing an HVP flash right there. So that could be associated with some positive returns, maybe. But I don't really. I've never really even looked really at HVP on 30-day Fed funds futures, but I'm sure it works more or less. I mean, that's just the nature of HVP. HVP is the consensus best indicator, and I mean HVE, HVP. That's pretty much, if you go back and look at calculating wealth streams. Shout out Calculating Wealth, aka Vlad or Michael Saylor, in the Discord. You could see, I mean, he was saying 2022 is going to be a volatile year. You're looking at HVP expansion, realized volatility, historical volatility is going to be expanding, increasing. So volatility returns is going to be increasing. And if you look back now, people would be asking if he's a genie or something. Unk has the best story about before Rona, saying, oh, hey dad, you should kind of manage your portfolio a little bit here. And then like 2 weeks later, just like a HVP just expansion to the moon, and returns were deeply negative there during that shock, or that, yeah. A lot of people will talk about drift and shock, and these are your drift indicators, and then this would be your shock right here. So this would also be your shock right here, shock to the drift. So right here you see drifting, and then there's variation with that, and that was associated with negative returns. Yo, thanks Weebos, for letting me know that the sound's too low. I'll turn that up a bit right there. My man, hopefully everything's all good with you, bro. I gotta say, I've had some of those penny. Yeah, how does that sound? Word up. All right, so I think we're gonna switch over. We're gonna switch over to Bloomberg. Let me know how that sounds, and I'm gonna make sure that we're not echoing, for God's sakes. Cool. So we're getting ready for this rate decision here. I might pop in every now and then. I'll be switching around on the charts, and I'll let you know if I see anything worthy of making a trade there. Do the same, mofos. Just kidding. All right, let's go. All right, so we can get this going.
To take the narrative away from people like Priya Misra?
So I think it's tricky for him. I mean, they've got a dual mandate, and when the two goals are in conflict, which I think they are, I don't think he can give much forward guidance. Even if he gives forward guidance, I think the Fed has lost credibility on it. They can't be data dependent and give us forward guidance. But if he can explain the reaction function and maybe say that parts of inflation, maybe this is an anathema to central bank watchers, parts of inflation the Fed has no control over. And so maybe they have to live with higher inflation for longer in order to get that softish landing. I don't think we're going to get, that's what I would have recommended to Chair Powell, but I think what we're going to get is we're going to go 75, we'll keep going, we've got to fight inflation. And I think that's what creates this risk of a hard landing, because they're going to keep going until they break something. And I think that process of breaking has already begun.
Priya, I want to pick up on that. That's really important. You think it's already started. You think that dual mandate is in conflict right now. Do you think they believe that?
I'm sure there are some at the FOMC that are concerned. You had President Bostic talk about maybe slowing down, getting to neutral. I think the biggest issue is things are slowing, and that's what tightening cycles are supposed to do. Are they slowing to trend, or are they slowing below trend? We don't have enough evidence of this, but I look at the tightening in conditions, the move in long and real rates, and it's hard for me to see that we'll stop just at trend, or that the labor market will just see a job openings going down, but layoffs don't happen. It's a very slippery slope between reducing job openings and actually letting people go. It just takes a while. So we may not see it on the data right now, but I think 6 months down the road, we will be looking at slowing. And that's when the Fed will see that the two goals are entirely in conflict.
And Matt Lazzetti of Deutsche Bank, over to you, sir. Do you agree?
So I think as we stand here today, the Fed needs to tighten policy both because inflation is too high and the labor market is too tight. Chair Powell has talked about the labor market being tight to an unhealthy degree. The San Francisco Fed staff put out a piece about neighborhood possibly being as high as 6%. Our own estimates are between 5 and 5.5%. So the tight labor market is feeding through into inflation pressures, and therefore I think both sides of their dual mandate today are really telling them to tighten. I completely agree that it takes time for these things to filter through into the economy. Perhaps it's happening a bit faster today, given what's happened with financial conditions. Our own shadow rate, which is able to encapsulate everything that the monetary policy is doing, has already risen to 3.3%. But I think the Fed needs growth to slow below potential. It's going to be difficult to calibrate getting below potential, but not into negative territory, given how high inflation is and given how quickly they're moving here.
Priya, I want to pick up on something you said, that you're already seeing a process of breaking down, kind of as people were expecting the Fed to raise rates until something broke. Well, it's happening. At what point does it cause them not to blink, but perhaps retrace some of their hopes for shrinking the balance sheet, particularly as you see credit spreads continue to widen?
Great point. We're not actually talking about the balance sheet because it's running in the background. But I think there is a nonlinear impact of tightening financial conditions, and I think that will only grow over time. Unfortunately, the Fed is not going to be nimble on the balance sheet. They've sort of told us that. They're going to be nimble on rate hikes. So I think if the economy starts to slow down, once they get well over neutral, maybe 3.5 or something, and at that point, do they slow down or stop hiking? I would see that or a lower bar for that than actually stopping the balance sheet. I think for the balance sheet to stop, they either have to see reserve scarcity, we're seeing no signs of that, or they have to see recession risk. I think before that, they would have probably stopped the hiking cycle. So I think the balance sheet, I'm glad you bring it up. It's happening in the background. It is moving those long and real rates. It's hurting the housing market or the other interest-sensitive sectors. That's a QT story, and QT is going to continue. In fact, I hope Chair Powell doesn't talk about MBS sales, because that will put it in another gear, in a higher gear, I think, if he starts talking about that as another way to tighten policy.
Matt, when we look at what the Fed's effect is on markets right now, do we have a sense of what the lag time is between the tightening and the slowdown that's actually due to what the Fed is doing and not just because of inflation itself?
Yeah, I know you typically have these views from the Fed models that monetary policy works with long and variable lags, and it could take upwards of 4 quarters to 6 quarters. But I think what we are seeing, is quicker than that. I think it has become embedded in market expectations. We very quickly saw the mortgage rate rise to 6%. Fed officials have been talking about the 2-year yield and how quickly that has risen. And we have seen a sharp tightening of financial conditions here. So I do think what the Fed has signaled has become embedded much more quickly. It does tell you that the economy, I think, can respond a bit more quickly than we've seen historically.
6 minutes away here from a Fed decision on Bloomberg Radio and Bloomberg Television. Matt Lazzetti, I want to talk to you about the disjoint curve, the path from high to lower inflation. There's got to be a point where the easy lifting gets done, and then it's tough to do so. Is that break point at 5%, at 4% inflation? Where do you estimate it is?
Yeah, so with the latest data, we have core PCE inflation almost near 5% at the end of this year and core CPI near 6% at the end of this year. And I think what has been really troubling within that data is it is not really about global supply chains and goods price inflation at the moment. It is about services inflation. It's about shelter inflation, rent and OER. And that's something that tends to be more persistent, more domestically oriented. And so I think it means a shift in the narrative about what we need to get inflation down. It is not really about global supply chains. That will help. but it really is about getting demand pressures down and a loosening in the labor market.
Is the price of the pandemic stimulus under national emergency that we codify Adam Posen's 3% inflation level is the new 2%?
Look, I think central banks cannot move in that direction today. We have worries about inflation expectations moving higher. We just saw the print from the University of Michigan on Friday. And so the Fed and central banks cannot suggest that they're going to allow for substantially higher inflation at the moment. That risks unanchoring inflation expectations and this becoming a much worse cycle that they have to deal with and slam the brakes on harder. Is it possible that as we look forward, the Fed gets inflation down into the 2.5% range or lower, and at that point they accept that at the expense of pushing the economy into a recession? I think that's a reasonable view of where we might be, but we need to get a lot of progress on the inflation front really to get back down to those levels.
John, I can't emphasize enough this disjoint analysis of a two-stage decline in inflation is the heart of the matter. In the press conference today, that's what Powell needs to do to get that conversation back in control.
ATK, I'm with you. It's an important question. Lisa, just how much inflation they're willing to tolerate. I don't think they want to address that today at all. This is about credibility.
This is about credibility in the near term. Long term, things will evolve as they are. I was just looking at five-year forward break-evens, basically a measure of 5 to 10-year inflation. It is creeping up slowly, well above that 2%, around 2.3 to 2.4% range. It has already gotten outside of what the Fed wants to see, and they're not jawboning that down.
Priya, I'd love your view on this. I think more recently, most of the fresh forecasts, the estimates, the guesses, call them what you will, ahead of this decision in about 4 minutes is for 75 basis points. Some still looking for 50. Priya, how do you think this bond market would respond to a 50 basis point hike? I know that's tremendously difficult to answer in isolation because we'll have the news conference, all the forecasts as well. But just the 50, how are you thinking about that if that's what we get in a couple of minutes?
Oh, I think it's positive. I would disagree that it's negative for risk assets. I think it's positive because it's telling you that the Fed doesn't want to overdo it. They want to calibrate policy in response to both aspects of the dual mandate. They can keep going 50. I mean, our call up until Monday was 50s all the way until December. If they communicate that, yes, it's just going to take longer to get inflation back to 2%, but they're doing it in slow steps. I think it's going to come down clearly to the messaging, but I think it's a big bull steepener. So front-end rates fall. I think that terminal rate comes down. This idea of a hard landing starts to recede a little bit because the Fed can calibrate quickly.
I wonder where that would leave the long end too. Priya, thank you. Priya Misra of TD, Matt Lazzetti of Deutsche Bank. We're about 2.5 minutes away from this. Anything between 50 to 75 basis points, take your pick, seems to be the theme on Wall Street. But a lot of that changed, Tom, after the CPI print on Friday. That's what introduced this idea that this Fed would have to go hard today.
By the conversation, we're going to have Scott Miner is going to join us. William Dudley will join us, of course, the former Fed president of the New York Fed. But, John, what we're going to really be doing is looking at the chairman of the Fed's data because the market is the chairman of the Fed right now. I'm sorry, the market is driving this conversation in McChesney Martin 101. That's not good.
And I throw in the Wall Street Journal report earlier this week, Tom.
It's happened
certainly
before.
The data sparked the directional move that we saw in yields and introduced, I think it was Barclays straight out the gate on Friday, Lisa, off the back of the CPI print. They kind of tiptoed in there and said 75 is coming.
I just thought of something.
Not just them. Go ahead, Tom.
Is Scott Miner the Fed whisperer?
He might be. Do you want to ask him?
I'm not going to ask him right now, but he might be.
Can Scott only talk after the decision, Tom?
No, after the decision. After the decision, it's only he can talk about Bitcoin. That's it.
I'm sure he can't wait for that. Bro, any final words going into this one? Because it's not just about the call, is it? It's about the forecast too. That dot plot, unemployment, growth, all of the above.
That's what I was going to say. And the outlook for the economy. If the Fed views this economy as very strong and signs of inflation increasing across the board, this could lead to a pretty bad reaction in equities despite the rally. On the flip side, you could see a pretty solid sense if people basically got the sense that Fed was going to raise rates 75 basis points, do it again, and then wait.
Do you remember the last time we got the forecast? What Dan Swank said?
Fantasyland.
Grant Thornton. Fantasyland. I'm very, very interested to see what happens with this unemployment outlook in just a couple of minutes' time. 3.5%, the current estimate. We're seconds away. Let's get you set up for it. Here's the price action going into it. Your equity market is positive by 1.3% on the S&P 500. On the Nasdaq, up by 2 percentage points. Into the bond market, we look a little something like this going into the decision. Yields are coming in on a 10-year, on a 2-year, on a 30-year. But that is not the theme that we've seen so far over the last week into today. Yields lower by around about 9 basis points on a 10-year. From New York in D.C. with your Fed decision, here's Mike McKee.
It is 75, and the Fed has significantly raised its forecasts for the Fed funds rate over the next few years, saying in their statement, the committee is strongly committed to returning inflation to its 2% objectives. Members now see the Fed funds median rate at 3.4% at the end of this year, 3.8% next year, and 3.4% in 2024. 5 members see the rate over 4% in 2023. The central bankers dropped their forecast that the labor market will remain strong, and they no longer say they expect inflation to fall back to 2%. The central bankers also say the unemployment rate will move up to 3.7% this year, 3.9% next year, and 4.1% in 2024. Given we're at 3.6% now, that would meet the test of the SOM rule, which posits that when you get a half percentage point rise in unemployment, you get a recession. However, the Fed is not forecasting recession this year. The headline inflation rate is seen as rising significantly, 5.2% this year. It's 6.3% now. That's PCE, which will fall to 2.6% next year and 2.2% in 2024. Quote, inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher energy prices, and broader price pressures, the statement says. The Russian invasion of Ukraine and related events, it says, are, quote, creating additional upward pressure on inflation and weighing on global economic activity. Also weighing on U.S. economic activity. This economy is going to slow significantly this year and the next 2 years, growing just 1.7% in 2022 and 2023, 1.9% in 2024. And there's one other surprise, guys, a dissent by Kansas City's Esther George, who wanted a 50 basis point move, smaller than the rest of the Open Market Committee.
Surprised to see that from Esther George, but that's a separate point. Mike McKee, thank you. Mike, stay close. I want to run through all of this right now on the S&P. In and around 1% higher on the S&P 500, up by 1.12%. On the Nasdaq, up by 1.8%. If we can work our way through a bond board, I'd love to do that, just to look at where treasuries are. Yields are still lower on the session. Some of that fades a little bit, lower by 6 basis points on a 10-year to 340, on a 2-year 335. But we did so much work, Tom, coming into this decision over the last week or so.
It's been extraordinary, and I really want to emphasize to people, this is history in the making. This is much more, John, than harkening back to 1994, which I remember as a tumultuous year. John, this goes back decades and decades and decades to how does a central bank raise rates politically. That's really much more what this is about.
And just looking at that dot plot, Lisa, to see us at 3.4% at the median dot for 2022, when back in December they were projecting 90 basis points for year-end 22. That's a massive change in just 6 months for this Federal Reserve.
There's also a massive change in the language, basically saying it is strongly committed to returning inflation to its 2% objective. They are reconfirming their commitment to this. This is regain credibility. Operation Regain Credibility for the Federal Reserve, trying to go out there and say, we are not going to stop raising rates until inflation comes back down to our target. And the constructive tone in markets indicates that it has been priced in. The press conference will be interesting.
Hey, we'll see. You and I have both said over the last news conferences, these moves in these markets.
Big time.
Yeah. We'll see. We'll see how the news conference goes. We'll see how we close, and we'll see how the next couple of days go as well. Tom, the chairman surprised people in the news conference last time around, being quite explicit, open about the guidance for the next couple of meetings.
Absolutely.
This news conference is going to be interesting.
It's going to be interesting. Colby Smith over at the FT, I think, really drove that market move forward, and McKee finished up on the back end of it. We'll bring you that press conference in a bit. Right now, in a joy, we saw him in Davos. Scott Miner joins us, and yes, we'll ask about Bitcoin, but at 2:04 p.m., we're not going to do Bitcoin. We're going to talk to Miner about the history of all this to give those younger perspective on this important moment. He is with Guggenheim. Scott, I'm going to cut to the chase. Is Greenspan's measured dead?
I think so. I think that, we're in an entirely different world, Tom. We haven't seen anything like this, where we have an inflation problem that we're fighting. And, the big difference, I think, between Greenspan and us today is Greenspan, as he referred to it, was in the era of opportunistic disinflation, right? We're not in that position anymore, right? Which is, every time the economy overheated, you ratchet it up, rates up, and then as soon as you saw weakness, you would start to come back down. We don't have those kinds of choices here.
You and I each have those moments that were a crisis moment that we didn't see coming. Right. I'm looking at a bond market that is a bear bond market priced down like I have never seen. The Fed can't ignore the collapse, as the ECB can't ignore the collapse in bond prices, right?
No, and it's interesting because I'm not sure what the cure is at this stage. I mean, when we came into this, it was interesting.
Isn't time the cure? Isn't that the solution? You go on the x-axis?
Well, time is the cure, but in some ways, I think they're running out of time. When you have BTPs in Italy go up 300 basis points, 3% since the beginning of the year from 1 to 4, it makes our bear market look like nothing comparatively. And the other side is that we saw those retail sales numbers today come out. Those were very weak numbers, and there's a chance that we are already in a recession. And so if we are in a recession or we're close to a recession and the Fed pushes on this more, and then we find that all of a sudden we have a decline in asset prices like stocks did in 87, then if the Fed reverses course, they're going to look like they're weak on inflation. So this is a very, very tough situation that we're maneuvering through.
Scott, given everything you're worried about, hasn't the Fed just committed to that now? Isn't this a commitment to that outcome? In all but name. They're not going to say it, but based on what they're doing, aren't they committing to that outcome?
Oh, I think they are, Jonathan. But the thing is that every time we get another bad piece of news on inflation, which is higher than expectation, then we're forcing the Fed to ratchet up their pace or the degree of tightening that they're doing. And coming into this meeting, honestly, I listened to the show earlier. I really thought we were to have a trade-off here between 75 basis points and 100 basis points, because I think the Fed really needs to send the message that it is going to crush inflation and do it as fast as possible.
Are they sending that by getting to 250, say? By the end of the July meeting, 225, 250, what they consider to be neutral. Scott, I'd love to know from your perspective what neutral actually is.
Well, I think, honestly, John, I think neutral is somewhere around 2.5%, but it's a 2.5% because we have two colliding things going on here. We have a rapidly decelerating economy, which is the result of companies that are feeling price pressures and not being able to pass those pressures on to consumers like Target and Walmart. And then simultaneously, we have an extremely aggressive Federal Reserve. And the data is moving so fast. I can't recall a time in my career where I can remember economic data and real-time earnings data shifting as quickly as it is now, while the Fed is being so aggressive.
Elisa, what did we hear from Priya Misra of TD? That this dual mandate was in conflict. 3 months ago, given where the economic data was at the time, I think a lot of people might push back against that. Here we are. A lot of people seem to be on board with that view.
Well, if you look at the economic projections, they now forecast from the Federal Reserve a 4.1% unemployment rate in 2024. Not that big of a divergence from where we are right now. Some, including Diane Swank, may still call that fantasy land. But, John, at what point do they start ratcheting back their fight on inflation to address the unemployment rate, or do they just not want to address it right now, to Priya Misra's point, because it seems like that is the only path to get them where they want to go?
Got a great lineup going into this news conference. That news conference with Chairman Powell starts in about 21 minutes' time. Subhadra Japa, the head of US rate strategy at SocGen, is with us now too. Subhadra, I'd love your view on all of this. Just first of all, your reaction to the Fed decision from 10 minutes ago.
So I think the Fed definitely caught up with the market pricing of rate hikes for the next couple of years. So really that was a little bit more than I had expected. I thought that they would be a little bit more gradual in catching up to the market pricing of rate hikes for the next couple of years. But you know what? I think that they said they're going to move expeditiously, and they've kind of stuck to their word. They're trying to not be in the same situation at the next meeting where they're playing catch up. So they've basically laid down the path, if you will, for the next couple of years. The question is if they'll be able to deliver on the path that they've laid out for the next couple of years, i.e. that we get to the end of the year, we start seeing a meaningful slowdown in growth, the consumer starts to buckle. Will they be able to deliver rate hikes at the pace at which they've kind of laid out for the next couple of years?
Subhadra, this is a tough one, so forgive me for asking it. And I know there's a lot of work to do at the news conference to work some of this stuff out, and for the next few weeks as well. What's your degree of confidence around the idea that we might have seen a peak in yields? Is this it?
So that's a very interesting question. I think that for my view coming into this meeting, to be honest with you, is that 10-year yields will probably stay anywhere between, I'd say, 275 and 350 for the remainder of the year. I think that sort of scenario still makes sense to me because a lot of this is going to get priced in the very front end of the curve. So I could perhaps see the 2-year part of the curve of the yield 2-year yield start to rise. The 10-year could still be relatively range bound, because the long end is going to be much more reactive to what happens on the recession front, on the consumer front, on the growth front. So that's really what the long end is going to be much more focused on. So I think the moves in the long end are going to be somewhat muted, and I can see potential for the yield curve to continue to flatten and perhaps even invert a lot more from here on.
Scott, do you agree? Buy long bonds?
I agree. I think Subhadra's hit the nail on the head. If my scenario, which is this weakening economy, is going to catch the Fed off guard, we're sitting at the peak or close to the peak in long-term rates, and our internal models just in the last week or so have flipped from favoring bonds to favoring long bonds today over owning stocks. And, bonds have really underperformed early on here in the year, and especially long duration. And I think now is the time that you have to be extending your duration and investing in longer dated securities.
Subhadra, one argument for buying riskier assets, particularly riskier credit, has been that the credit quality of companies will remain strong, that they have a lot of cash, they have refinanced a lot of their debt, things are going to be okay. Does that still hold water given a 4% terminal Fed funds rate, or perhaps 3.8%, as the Fed's own projections hold?
That's a very good question, and I think that's yet to be proven to be the case. Right? So far, we're not seeing any sort of signs of defaults rising. We're not really that concerned about corporate profit margins. They're still somewhat healthy for the most part. But 6 months into this, when the Fed funds rate is above 3%. I think it'll be a very, very different picture at that point. So at least between now and the time that the Fed is continuing to raise rates, I think the bias is going to be towards modestly wider spreads across the corporate bond spectrum.
On radio and television, an historic moment. Bloomberg surveillance here where the Fed decides, and I can just tell you, it's almost goosebumps when you look back at the history of this. Scott Miner, let's go all Michael Musa and the great Rudiger Dornbusch here. It's all about the dollar at the end of the day. It's the deepest part of the global system. As we speak, euro breaks down. I know there's a little bit of other story there as well, under a 104. What does the dollar signal to you? How should our listeners and our viewers use the dollar as a tool to guesstimate that inflation path?
Well, I think that the dollar, strengthening is obviously good for inflation. But, Tom, it's introducing a lot of other risks in the system.
Huge international risks.
Right. And you look at Japan. We have yield curve control and the yen depreciating rapidly. And, I always tell people you can't control interest rates and your exchange rate at the same time. You got to pick one or the other. And the Bank of Japan is facing a bit of a crisis here because with the yen at 135, they're going to accept a lot more inflation, or they're going to have to adjust yield curve
In
control.
Mandela, Columbia, I mean, it's simple. This is trilemma 101, and yes, each trilemma is there. What is Powell's trilemma in this press conference today, besides explaining away Esther George's shock dissent?
I think that Powell is going to have a hard time trying to explain to people that we can go down this interest rate path that they're outlining, and that we are not going to find ourselves in some kind of recession or financial accident. I think it's inevitable.
Okay, but what's so critical here, to me at least, is the headline, John, I'm sorry, I don't have it in front of me. The headline here, John, of inflation 9-ish now. Am I right, John, coming down to 5-ish? Fast-ish?
I mean, perhaps, Tom. Perhaps.
The rate of
Let's
change
see.
of
Based
decline in
on what,
inflation.
Tom? How much work do they need to do to get there?
Minor and I didn't live this. When we lived 9% inflation, it didn't move that fast. It's that simple.
No, and by the way, we have never had a period where inflation has come down by more than 2% without having a recession. So if those numbers are real, and that's what they're going to do, if that's going to what happen, we are destined for recession.
John, pick it up, please. Myron's wearing Dodger blue. I can't concentrate.
I'm just speaking to Greg Peters over at PGIM on the Bloomberg. He just wrote in, he said, too soon for bonds, too soon for credit. Getting close on bonds, but more price downside. Spreads are too tight. Scott, I'd love your thoughts on that. Spreads are too tight. If you look at things based on spreads are not as wide as they were back in late 2018 when the Fed was pushing really, really hard, and most people assumed too hard. This time they're doing a whole lot more. Inflation is in a very, very different place, and spreads have been south of 500 basis points. Is now the time to own credit at these levels?
I think we are currently well off of our maximum allocation to credit right now. If my view of the world is correct, recession means you're going to have wider credit spreads. And so, when you look at it, what's interesting, Jonathan, I was just with our credit team this morning. When you look at public companies, their numbers look pretty good with cash flow coverage and everything else. But the number of private equity firms where we don't know what that cash flow coverage is are much, much more extended. And then you have these one-off situations like Carvana, where the bonds are down 20% in the course of less than a month, which were just issued. I mean, there are cracks appearing in the credit world, and the worst is probably not over there. But for treasuries, long rates, this is a great time, I think, to put money to work.
With us right now, Scott Minard of Guggenheim. SocGen, Sabaja Rajapra, if you're just tuning in, it's 75. A 75 basis point interest rate hike from this Federal Reserve. A strong guide to more to come. On rates, they see rates on the Fed funds rate, the median forecast implied by the dot plot, 3.4% to 3.8%. to 3.4 again. So that's some cuts out there in the distance that Mike McKee talked about. On PCE inflation, it's the 5.2 you're talking about, Tom, year end. That's their new forecast for inflation, 23 2.6, 24 2.2. And Lisa, something we talked about last time around, the forecast from this Federal Reserve on unemployment. Diane Swank, who's not with us today, but we're thinking of her always, over at Grant Thornton. The last time we had some forecasts, she said they were fanciful. They had 3.5. Again, 3.5 next year. It's changed, Lisa. It's 3.7% this year, 3.9% next year, 4.1% the year after that. That's some pain in the labour market they weren't projecting last time around.
It's more pain. Is it enough pain? What does this market look like? What does the economy look like longer term? I'm looking at the reaction in longer term treasuries, and you can see that the yield gap between 10 and 30-year treasuries has actually inverted for the first time going back to 2006. This indicates very slow growth for a very long time, John, and it really raises some concerns over, and this is why I think credit becomes an issue, over how much people can grow into their leverage, how much companies can expand and actually get the earnings to back up their debt.
This line that jumps out in the statement for a lot of people, this commitment, the committee is strongly committed to returning inflation to its 2% objective. So, Badra, I'd love your view on this. If they are committed to returning inflation to a 2% objective, are they committed to causing some economic pain in this labour market?
It sure looks like it. And, to your point about Diane Swank, I think that the unemployment rate going up only to about 4% or slightly higher than that, it seems a little unrealistic. The question is that how much is the Fed going to be willing to tolerate higher unemployment for the sake of inflation? And I think that's really where, in some respects, this Fed is in a sweet spot, because even if the unemployment rate goes to, say, 4.5% or 5%, if they're able to continue to raise rates to bring down inflation, I think that's really what they're going to be focused on. So the question is, how quickly does the unemployment rate rise from here on? Right now, it doesn't seem to be in the cards. I mean, the unemployment, picture is still the employment picture is still very, very strong. And I think in this set of circumstance, the Fed's going to be singularly focused on inflation.
Scott, how much are you dusting off your stagflation playbook?
It's interesting because I think John got my message once on the air about 3 or 4 months ago while he was
Scott.
on. Yeah.
Yeah.
And boy, did I get shot at for that comment.
Do you remember how people responded to that?
Exactly.
Scott said the word stagflation. What did people say back, Scott? They laughed at you.
Well, yeah, I think that look, we're living in it now. The problem here for the Fed is, not letting it get ingrained into the system. And, I wish Diane were here today, though. Subhadra's doing a great job. But, all these numbers they threw out are fantasy land. The unemployment rate's fantasy land. The rate at which inflation is going to come down is fantasy land. I mean, if we're going to have that massive a deceleration in inflation by the end of the year, we're going to look at some pretty amazing numbers in the next 6 months to get the year-over-year rate down to that.
Subhadra, what's the message that you take away from this inversion of the 30-10s yield curve, that all of a sudden yields on 10-year treasuries are higher than over 30 years, over 3 decades, where you try to get a sense of what growth and inflation could look like?
I think that the inversion of the 10-30s curve is really where it all begins when you're looking at starting to price in a recession from the yield curve down the line, right? So the last part of the yield curve that's going to invert is the 3-month, 10-year part of the yield curve. But broadly speaking, it's really a message on the very longer term where yields will end up. Let's say that we do go into a recession next year, the Fed starts to cut rates. At that point, there's not going to be really a whole lot of stimulus that the Fed can provide. And we've kind of spent all of our fiscal stimulus. So the growth trajectory at that point, maybe a couple of years down the line, is going to be a lot slower than what we were expecting for this year. So, the market's basically saying that, ultimately you could be in sort of a lower for longer over the longer run as opposed to over the shorter run.
Scott, a lot of people are talking about credit needing to catch up with stocks. You need to catch up with some of the other risk assets, which have seen a much bigger hit over the past few months. Do you agree? Is this a time to start looking at stocks or, for example, Bitcoin, which you saw going down to $8,000 last time we spoke, and it seemed like a somewhat prescient call at the time?
Well, Lisa, I will say even a blind squirrel stumbles onto an acorn. But, I think that all risk assets are just a no-go zone. You don't want a lot of low-quality credit at this point. You don't want stocks. You want to really stay in the higher-end credit spectrum, and especially, treasuries, agencies, things like this that don't have credit risk. And again, in a recession scenario, which I think we're going into, none of the risk assets do well.
We're going to get back on the Fed track here in a moment. John will take you into the press conference, which is, I would suggest, the most historic press conference maybe in modern central banking, just to see what Jerome Powell says. Scott, we've got to take time here on Bitcoin, which has become, in my opinion, a national tragedy. Here's the BS from one of these people going down in flames. So-and-so is proud to provide a platform of curated services. We have curated ourselves from 60,000 down to 20,000. Forget about fancy people like you and me. People out there are getting absolutely crushed by this song and dance. Forget about the rich people. I'm talking mom and pop out there are getting crushed by Bitcoin. Where are the regulators? Ken Rogoff says they failed.
I think Ken's right. I mean, look, this was the hot potato nobody would look at. The CFTC finally agreed to allow for futures. Then we got ETFs. And what is this stuff? I mean, they say it's not a security, right? They say it's not a commodity.
It was a currency at one point. You and I memorized Securities Exchange Act 33 and 34. That's back when the remarkably short documents. We actually read those. Where are those equivalents in this casino?
As far as the regulators are concerned, they don't exist.
Are they going to exist at 8,000?
Oh, they're going to exist at some point. I mean, you're right. I think they won't exist at 8,000, Tom, because the regulators are too slow.
John, I know we got to get back on the press conference, but people want to know what Scott Miner
Well, before we get there, let's just connect it to the broader market. Scott, what's the relationship between what's happening with crypto right now and what's happening with the broader market?
Good question.
Right. Well, they're John, exactly what I talked about a year ago. This crypto has proven not to be the diversifying asset class. It is not the safe haven. It is a high beta play on risk. And so the collapse of crypto was the canary in the coal mine. I mean, this told us ahead of time that stocks were going to be in trouble and other risk assets, and they've led us all the way down. And until we find a bottom here in crypto, we're not going to get a bottom in anything else.
A lot of people share that view. I've heard a similar thing from Peter Cheer recently. Getting a ton of people writing in. Forgive me if I'm slightly distracted. Peter Cheer of Academy writing in and saying the following. We got the 75 basis points, serious about fighting inflation hike. Now we wait for the data-dependent and no-set core speech to get to new highs on risk assets, new recent highs, he says, if the morning game plan is going to play out. That was his game plan from earlier today. Neil Dutter of Renaissance Macro, much more constructive than most, usually. This is what he wrote into me just moments ago. The Fed is revising down growth, revising up unemployment, revising up inflation, which is a lagging indicator and also pushing up the path of interest rates. Lisa, here's a line for you. This is a recipe for recession.
Wow. Especially coming from someone who's been incredibly bullish on the economy. For someone to say this is a recipe for recession indicates the gravity, and what you're seeing right now being priced into certainly the bond market seems to suggest something more stagflationary or recessionary. At what point do they give some sense, they being the Federal Reserve, that they will then reverse course or be supportive in order to support growth? Can they, if they're facing off with stagflation and inflation remains persistently high?
Implied in the dots, isn't it? That they're going to have to be cutting rates at some point down the road. We're about 3-4 minutes away from a news conference with Chairman Powell after the Federal Reserve hiked interest rates 75 basis points. So, Badra, I'd like to come to you on just a final question for this news conference. What would you be asking the chairman straight out the gate after he delivers his statement?
I think that the question I'd want to know is how he's going to thread the needle on being able to raise rates without causing a meaningful slowdown in the economy. And if they do see meaningful slowdown in the economy, how do they plan to manage their policy mix, especially given the fact that now they are also unwinding their balance sheet? So it's going to get really, really tricky because, you know, on the background, you are seeing a tightening of cash in the system because they're gradually running off their balance sheet. So this is going to get really, really tricky.
Scott, we can squeeze it in. Just a final word from you, buddy. What would you want to hear from the chairman in 3 minutes' time?
I'd like him to explain what their reaction function is in relationship to exporting our monetary policy onto the rest of the world, in Europe and Japan, where they currently are under pressure because we're raising rates and it's driving the dollar up and it's causing them to have problems within their own economy. How do they expect to thread that needle?
And they import even more inflation off the back of it. Scott, wonderful. As always, Scott Minerd of Guggenheim, Subhadra Japa of SocGen, 2 minutes away from a Fed Chair Jay Pow news conference, Lisa, following a 75 basis point interest rate hike.
One of the most consequential news conferences that we've seen as the markets try to understand what the reaction function is, now saying that they expect a series of single 50 basis point rate hikes through the remainder of the year. How do they signal that they will change that either upward or downward? What data are they looking at? Clearly, the University of Michigan survey that came out on Friday with the longer-term inflation expectations spooked them enough to really get this reaction.
Tom Keene, is this a recipe for recession?
I'm not going to go there. I'm going to go to Paul Samuelson, 1948, in his classic textbook, where people like Scott Minerd have predicted 9 of the last 4 recessions, whatever it is, Scott. I'm going to have a little humility on that.
Sure.
But what I will say, John, is whether it's a recession, a mild recession, a growthiness recession, whatever it is, the middle class of this nation always gets crushed.
That quote,
always case.
Tom, always gets rolled out whenever we have a big market correction. And there's a reason for it. Does this become a self-fulfilling situation when you start to see financial conditions tighten as much as they have done, not just over the last year, but more recently too?
Yeah, I don't disagree with that at all. It's like when England loses to Hungary, it's self-fulfilling.
You wanted to squeeze that in with 45 seconds left.
Just,
nice.
You
don't get the final word. Bramo does. Lisa, final word going into this one.
To that point, how do they thread the needle talking about possible strength or the soft landing when so many people are laughing at them when they say soft landing? How do they then say, look, this is actually still an okay economy. What we're trying to do is affect prices that will actually help.
Chairman Powell's going to step up to the podium in just a moment. As we go into it, I want to bring you the price action going into it. The equity market just about positive on the S&P, up by 0.4%. The Nasdaq 100 up by about 1.13%. The Russell, the small caps, up 0.5%. Things are tricky with Fed Day. Even in the news conference, no idea where it goes from there. Into the bond market, yields look like this on 2s and 10s and 30s. Your bond market shaping up as follows. Yields coming in 3 basis points on a 2-year to about 339.64, on a 10-year 342.72. But it's not about today's moves. It's about the amount of weight we've added to a 10-year yield, a 2-year yield over the previous 5, 6, 7 days. Just unreal. 342.72. Here's the chairman of the Federal Reserve.
Good afternoon. I will begin with one overarching message. We at the Fed understand the hardship that high inflation is causing. We're strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Overall economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we've seen in recent months should continue to temper growth and help bring demand into better balance with supply. As shown in our summary of economic projections, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth running below 2% through 2024. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. FOMC participants expect supply and demand conditions in the labor market to come into better balance, easing the upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises somewhat over the next few years, moving from 3.7% at the end of this year to 4.1% in 2024, levels that are noticeably above the March projections. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core prices rose 4.9%. In May, the 12-month change in the Consumer Price Index came in above expectations at 8.6%, and the change in the core CPI was 6%. Aggregate demand is strong. Supply constraints have been larger and long-lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and food and is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to exacerbate supply chain disruptions. FOMC participants have revised up their projections for inflation this year, particularly for total PCE inflation, given developments in food and energy prices. The median projection is 5.2% this year and falls to 2.6% next year and 2.2% in 2024. Participants continue to see risks to inflation as weighted to the upside. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 percentage point, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Coming out of our last meeting in May, there was a broad sense on the committee that a 0.5 percentage point increase in the target range should be considered at this meeting if economic and financial conditions evolved in line with expectations. We also stated that we were highly attentive to inflation risks and that we would be nimble in responding to incoming data and the evolving outlook. Since then, inflation has again surprised to the upside. Some indicators of inflation expectations have risen, and projections for inflation this year have been revised up notably. In response to these developments, the committee decided that a larger increase in the target range was warranted at today's meeting. This continues our approach of expeditiously moving our policy rate up to more normal levels, and it will help ensure that longer-term inflation expectations remain well anchored at 2%. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 3.4% at the end of this year, a percentage point and a half higher than projected in March, and 0.9 percentage point above the median estimate of its longer-run value. The median projection rises further to 3.8% at the end of next year and declines to 3.4% in 2024, still above the median longer-run value. Of course, these projections do not represent a committee plan or decision, and no one knows with any certainty where the economy will be a year or more from now. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. Clearly, today's 75 basis point increase is an unusually large one, and I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting. We will, however, make our decisions meeting by meeting, and will continue to communicate our thinking as clearly as we can. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Howard Schneider with Reuters. Two related questions. Chair Powell, did you feel you boxed yourself in with the language you used at the last press conference on 50 basis point hikes in June and July? And would you please give us as detailed a sense as you can of what role you played in reshaping market expectations so quickly on Monday?
So, as you know, we always aim to provide as much clarity as we can about our policy intentions, subject to the inherent uncertainty in the economic outlook, because we think monetary policy is more effective when market participants understand how policy will evolve, when they understand our objective function, our reaction function. And in the current highly unusual circumstances with inflation well above our goal, we think it's helpful to provide even more clarity than usual, again, subject to uncertainty in the outlook. So, and I think over the course of this year, financial markets have responded and have generally shown that they understand the path we're laying out. Of course, it remains data dependent, and so that's what we generally think about guidance, and that's why we offer it. And of course, when I offered that guidance at the last meeting, I did say that it was subject to the economy performing about in line with expectations. I also said that if the economy performed, if data came in worse than expected, then we would consider moving even more aggressively. So we got the CPI data and also some data on inflation expectations late last week, and we thought for a while, well, this is the appropriate thing to do. So then the question is, what do you do? And do you wait 6 weeks to do it at the next meeting? And I think the answer is that's not where we are with this. So we decided we needed to go ahead, and so we did. And that's really how we made the decision.
Gina?
Thanks for taking our questions. Gina Smilik with the New York Times. I guess I wonder if you could describe for us a little bit how you're deciding how aggressive you need to be. So obviously 75 today. What did 75 achieve that 50 wouldn't have, and why not just go for a full percentage point at some point?
Sure. So if you take a step back, what we're looking for is compelling evidence that inflationary pressures are abating and that inflation is moving back down. And we'd like to see that in the form of a series of declining monthly inflation readings. That's what we're looking for. And by this point, we had actually been expecting to see clear signs of at least inflation flattening out and ideally beginning to decline. We've said that we'd be data dependent, focused on incoming data, highly attentive to inflation risks, the things that I mentioned to Howard moments ago. So contrary to expectations, inflation again surprised to the upside. Some indicators of inflation expectations have risen, and projections of this year have moved up notably. So we thought that strong action was warranted at this meeting, and today we delivered that in the form of a 75 basis point rate hike, as I mentioned. So what was the point of it really is this. We've been moving rates up expeditiously to more normal levels. And over the course of the 7 months since we pivoted and began moving in this direction, we've seen financial conditions tighten, and appropriately so. But the federal funds rate, even after this move, is at 1.6%. So, again, the committee is moving rates up expeditiously to more normal levels. And we came to the view that we'd like to do a little more front-end loading on that. So I think that the SEP gives you the levels that people think are appropriate at given points in time. This was really about the speed with which you would get there. So as I mentioned, we 75 basis points today. I said the next meeting could well be about a decision between 50 and 75. That would put us at the end of the July meeting, in that range in that more normal range, and that's a desirable place to be because you begin to have more optionality there about the speed with which you would proceed going forward. Just talking about the SEP for a second, what it really says is that committee participants widely would like to see policy at a modestly restrictive level at the end of this year, and that's 6 months from now. And so much data and so much can happen. So remember how highly uncertain this is. But so that is generally a range of 3 to 3.5%. That's where people are, and that's what they want to see, knowing what they know now and understanding that we need to show resolve, but also be flexible to incoming data as we see it. If things are better, we don't need to do that much. And if they're not, then we either do that much or possibly even more. But in any case, it will be very data dependent. Then you're looking at next year, and what you're seeing is people see a bit more tightening in a range of maybe 3.5 to 4%, and that's generally what people see as the appropriate path for getting inflation under control and starting back down and then getting back down to 2%. So 75 basis points seem like the right thing to do at this meeting, and that's what we did.
Steve Leisman, CNBC. Thank you for taking my question, Mr. Chairman. You have not used the phrase in a long time, monetary policy is in a good place, which is a phrase that you used to use often. Now that the committee is projecting 4% or 3.8% next year in terms of the funds rate, which is similar to where the market is now, the futures market of 4% funds rate next year, do you think that's a level that is going to be sufficiently high enough to deal with and bring down the inflation problem? And just as a follow-up, could you break that apart for me? How much of that is restrictive, and how much of that is a normal positive rate that ought to be embedded or not, in your opinion, in the funds rate? Thank you.
Sure. So the question really is, how high does the rate really need to go? And this is, the estimates on the committee are in that range of 3.5 to 4%. And how do you think about that? Well, you can think about the longer run neutral rate. You can compare it to that, and we think that's in the mid twos. You can look, frankly, at broader financial conditions. You can look at, asset prices. You can look at the effect you're having on the economy, rates, asset prices, credit spreads. All of those things go into that. You can also look at the yield curve and ask all along the yield curve, where is the policy rate? So for much of the yield curve now, real rates are positive. That's not true at the short end. At the short end of the yield curve in the early years, you don't have you have negative rates still. So that really is one data point. It's one part of financial conditions. So I think I have to look at it this way. We move the policy rate. That affects financial conditions, and that affects the economy. We have, of course, rigorous ways to think about it, but ultimately it comes down to, do we think financial conditions are in a place where they're having the desired effect on the economy? And that desired effect is, we'd like to see, demand moderating. Demand is very hot still in the economy. We'd like to see the labor market getting better in balance between supply and demand, and that can happen both from supply and demand. Right now, demand is substantially higher than available supply, though. So we feel that there's a role for us in moderating demand. Those are the things we can affect with our policy tools. There are many things we can't affect, and those would be, the things, the commodity price issues that we're having around the world due to the war in Ukraine and the fallout from that, and also just all of the supply side things that are still, pushing upward on inflation. So that's really how I think I would think about it.
But just 3.8%, 4% get it done. Does it get the job done of breaking the back of inflation?
I think it's certainly in the range of plausible numbers. I think we'll know when we get there, really. I mean, honestly, that would be, you would have positive real rates, I think, and inflation coming down by then. I think you'd have positive real rates across the curve. I think that the neutral rate is pretty low these days. So I would think it would, but you know what? We're going to find that out empirically. We're not going to be completely model-driven about this. We're going to be looking at this, keeping our eyes open and reacting to incoming data, both on financial conditions and on what's happening in the economy.
Thanks. Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that you like your policy to work through expectations, and now obviously this decision was something quite different from how you and almost all of your colleagues had set those expectations during the intermeeting period. And I know you just said that what changed was really the inflation data, the inflation expectations data, but I'm wondering on the inflation expectations data, was there something you saw that was unsettling enough to risk eroding the credibility of your verbal guidance by doing something so different from what you had socialized before?
So if you look at we look at a broad range of inflation expectations. So you've got the public, you've got surveys of the public and of experts, and you've also got market-based. And I think if you look across that broad range of data, what you see is that expectations are still in the place, very much in the place, where short-term inflation is going to be high, but comes down sharply over the next couple of years. That's really where inflation expectations are. And also, as you get away from this episode, they get back down close to 2%. And so this is really very important to us that remain the case. And I think if you look for most measures, most of the time, that's what you see. If we even see a couple of indicators that bring that into question, we take that very seriously. We do not take this for granted. We take it very seriously. So the preliminary Michigan reading, it's a preliminary reading. It might be revised nonetheless. It was quite eye-catching, and we noticed that. We also noticed that the index of common inflation expectations at the board has moved up after being pretty flat for a long time. So we're watching that, and we're thinking, this is something we need to take seriously. And that is one of the factors, as I mentioned, one of the factors in our deciding to move ahead with 75 basis points today was what we saw in inflation expectations. We're absolutely determined to keep them anchored at 2%. That was one of the reasons. The other was just the CPI reading.
So if you saw a movement like that again, another tick up in inflation expectations, would that put a 75 or even 100 basis point increase in play at your next meeting?
I'll just say we're going to react to the incoming data and appropriately, I think. So I wouldn't want to put a number on what that might be. The main thing is to get rates up, and then pretty soon we'll be in an area where we're, I think, as you get closer to the end of the year, you're in a range where you've got restrictive policy, which is appropriate, 40-year highs in inflation. We think that policy is going to need to be restrictive, and we don't know how restrictive. So I think that's how we'll take it.
Hi, Chair Powell. Neil Irwin from Axios. Thanks for taking our questions. The late-breaking kind of decision to go to 75 basis points, do you worry that will make policy guidance a less effective tool in the future? And should we think of that as a kind of symmetrical reaction function if we start to get soft readings on inflation or if the labor market starts to roll over?
To take your second question first, yes. I mean, I think we're resolved to take this on, but we're going to be flexible in the implementation of it. Sorry, and your question was guidance. So again, the overall exercise is that we try to provide as much clarity about our policy intentions as we can, because we think that makes monetary policy work better. It's always a trade-off, because you have to live with that guidance, and so you do it, and it helps a lot of the time. I frankly think this year has been a demonstration of how well it can work. With us having really just done a very little in the way of raising interest rates, financial conditions have tightened quite significantly through the expectations channel, as we've made it clear what our plans are. So I think that's been a very healthy thing to be happening. So. And I would hope that it's always going to be any guidance that we give is always going to be subject to things working out about as we expect. And in this particular situation, we're looking for something specific, and that is progress on inflation. We want to see progress. We want to see inflation can't go down until it flattens out. And that's what we're looking to see. And if we don't see that, then that's the kind of thing that will cause, even if we don't see progress for a longer period, that could cause us to react. But we will soon enough, we will be seeing some progress at some point. And we'll react appropriately to that too. But I would like to think, though, that our guidance is still credible, but it's always going to be conditional on what happens. This is an unusual situation to get, some data late during blackout, pretty close, very close to our meeting. Very unusual to one that would actually change the outcome. So. I've only seen, in my 10 years plus here at the Fed, I've only seen something like that, even close to that, 1 or 2 times. So I don't think it's something that'll come up a great deal.
Colby. Thank you so much for taking our questions. Colby Smith with the Financial Times. On the clear and convincing threshold for the inflation trajectory, what is the level of realized inflation that meets that criteria? And how is the committee thinking about the potential trade-off of much higher unemployment than even what's forecasted in the SEP if inflation is not moderating, at this acceptable pace?
Sorry, the second part I didn't get.
What's the potential trade-off with higher unemployment than even what's forecasted in the SEP if inflation is not moderating at an acceptable pace?
Right. So what we want to see is a series of declining monthly readings for inflation, and we'd like to see inflation headed down. So, and right now our policy rate is well below neutral, right? So soon enough we'll have our policy rate. Let's assume the world works about like the SEP says. The policy rate will be up where we think it should be, and then the question would be, do you slow down? Does it make you, you'll be making these judgments about, is it appropriate now to slow down from 50 to 25, let's say, or speed up? So that's the kind of thinking we'll be doing, and we're looking, ultimately, we're not going to declare victory until we see a series of these, really see convincing evidence, compelling evidence that inflation is coming down. And that's what I mean by, that's what it would take for us to say, okay, we think this job is done, because we saw, frankly, we saw last year, inflation came down over the course of the summer and then turned right around and went back up. So I think we're going to be careful about declaring victory. But again, the implementation of our policy is going to be flexible and sensitive to incoming data.
Are you more concerned now that to bring down inflation, it's going to require more than just some pain at this point?
So again, I think that I do think that their objective, and this is what's reflected in the SEP, but our objective really is to bring inflation down to 2% while the labor market remains strong. I think that what's becoming more clear is that many factors that we don't control are going to play a very significant role in deciding whether that's possible or not. And there I'm thinking, of course, of commodity prices, the war in Ukraine, supply chain, things like that, where we really can't. The monetary policy stance doesn't affect those things. So, but having said that, there is a path. There's a path for us to get there. It's not getting easier. It's getting more challenging because of these external forces, and that path is to move demand down, and you have a lot of surplus demand take for example in the labor market. So you have 2 job vacancies essentially for every person actively seeking a job, and that has led to a real imbalance in wage negotiating. You could get to a place where that ratio was at a more normal level, and you would expect to see those wage pressures move back down to a level where people are still getting healthy wage increases, real wage increases, but at a level that's consistent with 2% inflation. So that's a possibility, and you could say the same thing about some of the product markets where there's just excess capacity, And where the strong demand has gone into where they're capacity constrained, right? So you have effectively what we think of as a vertical supply curve or close to it. So demand comes in and it's very strong, and it shows up in higher prices, not higher quantities, not more cars, because they can't make the cars because they don't have the semiconductors. So in principle, that could work in reverse. When demand comes down, you could see, and it's not guaranteed, but you could see prices coming down more than the typical economic relationships that you see in the textbooks would suggest, because of the unusual situation we're in on the supply side. So there's a pathway there. It is not going to be easy, and again, it's our objective, but as I mentioned, it's going to depend to some extent on factors we don't control.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. So the new projections show the unemployment rate ticking up through 2024. Is a higher unemployment rate necessary in order to combat inflation? And what is lost if the unemployment rate has to go up and people lose their jobs in order to control inflation? Thank you. So
you're right. In the SEP, we have unemployment going up to 4 point. The median is 4.1%. There are, of course, a range of actual forecasts, and I would characterize that if you were to get inflation down to, on its way down to 2%, and the unemployment rate went up to 4.1%, that's still a historically low level. We hadn't seen unemployment rates below 4% until a couple of years ago. We'd seen it for like 1 year in the last 50. So the idea that 3.6% is historically low in the last century. So a 4.1% unemployment rate with inflation well on its way to 2%, I think that would be I think that would be a successful outcome. So we're not looking to have a higher unemployment rate, but I would say that I would certainly look at that as a successful outcome.
Does that include people losing their jobs, or?
We don't seek to put people out of work. Of course, we never think too many people are working and fewer people need to have jobs. But we also think that you really cannot have the kind of labor market we want without price stability. And we have to go back and establish price stability so we can have that kind of labor market. And that's a labor market where, where workers are getting wage increases. Maybe the workers at the lower end of the spectrum are getting the biggest wage increases, as they were before the pandemic, where participation is high, where there's lots of job opportunities, where it's just the labor market we had before the pandemic that's what we want to get back to. And you see, disparities between various groups at historic lows. We'd love to get back to that place, but to get there, it's not going to happen with the levels of inflation we have. So we have to restore that, and it really is in service in the medium and longer term of the kind of labor market we want and hope to achieve.
Hi, Chair Powell. Matthew Bosa with Bloomberg. So as you just mentioned, the committee is now projecting a 0.5 percentage point rise in the unemployment rate in the SEPs over the next couple years. And it removed a line from its policy statement about thinking that the labor market can remain strong while it tightens policy. You just mentioned that is still your objective, though. So I'm wondering if you could explain why that line was removed from the statement, and also whether this means the FOMC is trying to induce a recession now to bring inflation down.
Not trying to induce a recession now. Let's be clear about that. We're trying to achieve 2% inflation consistent with a strong labor market. That's what we're trying to do. So let me talk about that sentence. Clearly, it's our goal to bring about 2% inflation while keeping the labor market strong, right? And that's kind of what the SEP says. The SEP has inflation getting down to a little above 2% in 2024 with unemployment at 4.1%. So, and this is a strong labor market. This is a good labor market. And as I mentioned, there are pathways to do it. But those pathways have become much more challenging due to factors that are not under our control. Again, thinking here of the fallout from the war in Ukraine, which has brought a spike in prices of energy, food, fertilizer, industrial chemicals, and also just the supply chains more broadly, which have been larger than, or longer lasting than anticipated. So the sentence that we deleted said that we believe that appropriate monetary policy effectively alone can bring about the result of 2% inflation with a strong labor market. And so much of it is really not down to monetary policy. It just didn't. It just the sentence isn't. It kind of says on its face that monetary policy alone can do this, and that's not. That just didn't seem appropriate. So we took the sentence out.
And given the new projections for the unemployment rate, could you talk a little bit about what accounts for such reduced confidence against, say, a month ago or 3 months ago that inflation will largely normalize on its own as these supply side issues get worked out? Thanks.
Well, yeah, I think you've seen. Again, we've been expecting progress, and we didn't get that. We got sort of the opposite. So I also think the situation really since the consequences of the Ukraine war become more and more clear. What you're seeing is the situation getting more difficult. And you look around the world. I mean, lots of countries are looking at inflation of 10%, and it's largely due to commodities prices. But all over the world, you're seeing these effects, and and we're seeing them here. Gas prices, all-time highs and things like that. That's not something we can do something about. So. That is really, and by the way, headline inflation is important for expectations. The public's expectations, why would they be distinguishing between core inflation and headline inflation? Core inflation is something we think about because it is a better predictor of future inflation. But headline inflation is what people experience. They don't know what core is. Why would they? They have no reason to. So expectations are very much at risk due to high headline inflation. So it's become, the environment has become more difficult, clearly, in the last 4 or 5 months. And hence the need for the policy actions that we took today, hence our resolution to get rates up and ultimately get them to where we think they need to be. In coming months.
Thanks, Chair Powell. Edward Lawrence with Fox Business. I want to ask you, you talked about CPI going to 8.6%. The retail sales surprised the market by falling, and then revisions to the previous months were down. Are you hearing from contacts about consumers slowing spending or changing their habits?
So we're, of course, watching very, very carefully for that, and looking at the retail sale, the big store numbers, and all that kind of thing. And so, but I think the fair summary of what we see is you see continuing shifts in consumption. You see some things sales going down, but overall, spending is very strong. The consumer's in really good shape financially. They're spending. There's no sign of a broader slowdown that I can see in the economy. People are talking about it a lot. Consumer confidence is very low. That's probably related to gas prices, and also just stock prices to some extent for other people. But that's what we're seeing. We're not seeing a broad slowdown. We see job growth slowing, but it's still at quite robust levels. We see the economy slowing a bit, but still growth levels, healthy growth levels.
So then as you are raising rates in this economy, how closely are you watching consumer spending, or is there another indicator that you're watching more closely?
It would be hard to watch anything much more closely than we watch consumer spending, but we watch everything. We watch business fixed investment, which actually has softened a bit. We watch. We're responsible for watching everything, but consumption is 60-some% of the economy, 2/3 of the economy. So naturally, we spend a lot of time on that. And again, there's a lot going on. There are a lot of flows back and forth, but ultimately, it does appear that the U.S. economy is in a strong position and well positioned to deal with higher interest rates.
Thank you, Mr. Chairman. Michael McKee from Bloomberg Radio and Television. Are you targeting headline inflation now or core inflation? In other words, how far would you chase oil prices if they keep going up, if that's going to be the component that drives expectations? Would you risk recession for a headline rate if the core rate is holding steady or starting to go down?
So we're responsible for inflation in the law, and inflation means headline inflation. So that's our ultimate goal. we, of course, like all central banks do, look very, very carefully at core inflation because it's a much better predictor, and it's a much better predictor of where inflation is going, and it's also more relevant to our tools. As I mentioned, the parts that don't go into core are mostly outside the scope of our tools, so we look at that. But the current situation is particularly difficult because of what I mentioned about expectations. We can't affect. Really, I mean, the energy prices are set by global commodity prices, and most of food, not all of it, but most food prices are pretty heavily influenced by global commodity prices too. Also, other things. So we can't really have much of an effect, but we have to be mindful of the potential effect on inflation expectations from headlines. So it's a very difficult situation to be in. And we can't do much about the difference between the elements that make up headline that are not in core.
Could I just, as a follow-up, get a clarification on the SEP? When the members gave their forecasts, when were they inserted into the record? Were they revised after the CPI or Michigan numbers came out? In other words, does the SEP as we have it now reflect the same factors that led you to go to a 75 basis point move?
The SEP is of one piece. It reflects all of the economic readings. It also reflects the 75 basis point increase. This is important. So people had that in hand when their SEPs were submitted. So in other words, it's not in addition to what's in the SEP. The SEP, everyone's SEP reflects their thinking about this rate increase and what's going forward.
Victoria. Hi, Victoria Guida from Politico. I wanted to ask about how you're measuring progress, especially since you've now started front-loading rate hikes more. You've talked about how you want to see inflation coming down over a series of reports, and I guess I'm curious whether you think inflation data itself is a really good indicator, or whether you might be concerned that it's a lagging indicator, or that it might send confusing signals, given that, as you've talked about, there are sort of supply and demand aspects. And I guess my question is, do you think that inflation data will tell you when you've gone to where you need to go, or do you just feel like maybe it's better to overshoot than to undershoot?
So I think the role that we can play, maybe the way to get at it is to say that the role that we can play is around demand, right? So, and we'll be able to see the areas that we can affect are those that are associated with excess demand. And we'll be able to see our effect on, for example, job openings in real time. So, that would tell us about wages. Wages are not principally responsible for the inflation that we're seeing, but going forward, they would be very important, particularly in the service sector. So, sorry, I'm not sure I'm getting to your question.
My question is inflation data itself the best indicator for when you're getting to where you need to go, or might it lead you to go too far?
There's always a risk of going too far or going not far enough. And it's going to be a very difficult judgment to make, or maybe not. Maybe it'll be really clear. But we're quite mindful of the dangers. But I will say the worst mistake we could make would be to fail. It's not an option. We have to restore price stability. We really do, because it's the bedrock of the economy. If you don't have price stability, the economy is really not going to work the way it's supposed to. It won't work for people. Their wages will be being eaten up. So we want to get the job done. This inflation happened relatively recently. We don't think that it's affecting expectations in any kind of fundamental way. We don't think that we're seeing a wage price spiral. We think that the public generally sees us as very likely to be successful in getting inflation down to 2%, and that's critical. It's absolutely key to the whole thing that we sustain that confidence. So that's how we're thinking about it.
Hi, Brian Chung with Yahoo Finance. I just want to expand, I guess, on what you just said now about the general public feeling like you can get this done. When you talk about consumer sentiment being down, household inflation expectations being up, recession just broadly being dinner table talk, does the general feel among American households and also businesses square with your explanation of the economy, given that the description of inflation in the statement didn't change between May and June? Thanks.
So clearly, people don't like inflation a lot, and many people are experiencing it really for the first time, because we haven't had anything like this kind of inflation in 40 years, and it's really something people don't like, and they're experiencing that, and that's showing up in surveys and in all kinds of ways. And we understand that, and we understand the hardship that people are experiencing from high inflation, and we're determined to do what we can to get inflation back down. So that's really what we're saying. Clearly, it's an incredibly unpopular thing, and it's very painful for people. So, I guess what I'm saying is the really critical question from the perspective of doing our job is making sure that the public does have confidence that we have the tools and will use them, and they do work to bring inflation back down over time. It will take some time, we think, to get inflation back down, but we will do that.
Chris. Thank you. Chris Rugaber at Associated Press. You have talked about inflation a few times and mentioned oil prices, China lockdowns. But aside from rises in commodity prices such as gas prices, we're also seeing stickier measures of inflation increasing, such as the Cleveland Fed's median and trimmed mean CPIs. I mean, how persistent do you see those underlying measures of inflation, and how do you expect to, and where do you see those going in the near future?
Yeah. So, as I mentioned, I think in my opening statement, the inflation has started off in quite narrow, very directly pandemic-related areas, and it's spread now broadly across the economy and into the services sector as well. It was really in the goods sector at the beginning. In particular, you're seeing in travel now, if you've flown on a plane lately, planes are very full and plane tickets are very expensive. Some of that will be passed through of energy prices, but so you're experiencing services inflation. Shelter inflation is high. So the question, and you see the Cleveland measure going up, and many other measures are going up. So it's a time when we're not seeing progress, and we want to see progress, and that's really another part of why we did what we did today, and why the SEP looks like it does, is that we see it as appropriate to get the policy rate up to restrictive levels, which would be, in the thinking of the committee, somewhere in the range of 3 to 3.5% by year end, and then after that, you see what the rest of the SEP says. So I hope that's responsive to your question.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Do you still think a softish landing is possible, and how would you define that at this point, considering the revised projections for unemployment, GDP, inflation?
So I think what's in the SEP would certainly meet that test. If you see, you're looking at getting back down to almost a 2% inflation by 2024, and the unemployment rate is still as low as 4.1%. I would call that as meeting that test. Do I still think that we can do that? I do. I think there's. I don't want to be the handicapper here. That is our objective. And I do think it's possible. Like I said, though, I think that events of the last few months have raised the degree of difficulty, created great challenges. And again, the answer to the question, can we still do it, there's a much bigger chance now that it'll depend on factors that we don't control, which is, fluctuations and spikes in commodity prices could wind up taking that option out of our hands. So we just don't know. But we're focused on, very, very focused on getting inflation back down to 2%, which we think is essential for the benefit of the public, and also to put us on a path back to a sustainably strong labor market like the one we had before the pandemic.
Greg.
Thank you. Greg Robb from MarketWatch.
Chair Powell, I was wondering if you could talk a little bit more. Economists are worried that you're kind of hitting the economy with a sledgehammer, and that now there's even more risk of a recession than a 50-50 path of rates. So could you talk a little bit more about that, and what evidence would get you to stop rate hikes and maybe even reverse them?
Sure. So, as I mentioned, financial conditions have tightened over the last 7 months, and that's a good thing, we think. But the federal funds rate, even after this increase, is at 1.6%. So it's hard to see how that is too high of a rate. And even if we did another, we're going to get here by the end of the summer somewhere in the twos probably. Still, that's still a low rate. So that's not a rate that is calculated to bring a recession on. And by then we'll have seen a whole lot more data. As I mentioned a couple times, the committee's views are around a modestly restrictive stance, which would be in the 3 to 3.5% range by the end of this year. But that's conditioned on that being the appropriate thing to do. If we see data going in a different direction, it'll be reflected in our policy, as you see today. We'll be watching if things go in a direction we don't expect, then we're going to adapt. And I would say this is a highly uncertain environment, extraordinarily uncertain environment. So, again, we'll be determined and resolved, but flexible.
Okay, Evan.
Evan Reiser, Market News International. Thank you, Chair Powell. I was wondering if the Fed has initiated a review of the conduct of monetary policy over the last 2 years or so, given the inflation, and will that be shared with the public? And then secondly, given the illiquidity and extraordinary volatility in financial markets, are you concerned that QT will make that worse?
Sorry, what was your question on QT?
Just given the illiquidity and extraordinary volatility in financial markets, whether QT will make things worse.
So, of course, we've been looking, very carefully and hard at why inflation picked up so much more than expected last year and why it proved so persistent. It's hard to overstate the extent of interest we have in that question, morning, noon, and night. So, but you have to understand the context. Really, the context is this: for decades before the pandemic and the reopening, you had a world where inflation was dominated by disinflationary forces such as declining population or aging demographics, let's call it that, globalization enabled by technology, other factors, low productivity. So, and that's how all the models work. It is decades and decades of data. They look at that. It's a very flat Phillips curve work, and the supply shocks tend to be transient, right? So we have now experienced an extraordinary series of shocks, if you think about it. The pandemic, the response, the reopening, inflation, followed by the war in Ukraine, followed by shutdowns in China, the war in Ukraine potentially having effects for years here. So we're aware that a different set of forces are driving the economy. We have been, obviously, for quite a while, that these forces are different. Inflation's behaving differently. And in our thinking, it really is a question of very strong demand, but you couldn't get this kind of inflation without a change on the supply side, which is there for anybody to see, which is these blockages and shortages and people dropping out of the labor force and things like that. So that's how we're looking at it. And we've done a lot of work internally on and thinking about what all that means. The thing is, you don't know whether those forces what extent are they going to be sustained. In other words, will we go back to a world that looks a little more like the old world, or are we really going to be in a world where major supply shocks go on and on? The history is you see these waves of supply shocks, as you did in the 70s, and then they go away, and sort of there's a new normal and things settle down. But honestly, we don't know what that's going to be. In the meantime, we have to find price stability in this new world and maximum employment in this new world where clearly inflationary forces are, you're seeing them everywhere. Again, if you look around the world at where inflation levels are, it's absolutely extraordinary. It's not just here. In fact, we're sort of in the middle of the pack, although I think we have, of course, a different kind of inflation than other people have, and partly because our economy is stronger and more highly recovered. So that's what we're doing. We've done a lot of introspection and work on that. And sorry, on QT, we've communicated really clearly to the markets about what we're going to do there. Markets seem to be okay with it. We're phasing in. Treasury issuance is down quite a lot from where it's been. So I have no reason to think markets are forward-looking and they see this coming. I have no reason to think it will lead to illiquidity and problems. It seems to be kind of understood and accepted at this point.
Thanks. For the last question, we'll go to Mark.
Mr. Chairman, Mark Hamrick with Bankrate. Wonder what your assessment is about the outlook for the housing market, given the years-long increase in home prices and now the sharp rise in mortgage rates. And all that, of course, given the heightened sensitivity around the housing market, given the fact that it was a trigger for the great financial crisis over a decade ago. Thank you.
Sure. So rates were very low. A good place to start is that rates were very, very low for quite a while because of the pandemic and the need to do everything we could to support the economy when unemployment was 14% and the true unemployment rate was well higher than that. So, and that was rates are low, and now they're coming back up to more normal or above levels. So in the meantime, while rates were low and while demand was really high, obviously demand for housing changed from wanting to live in urban areas to some extent to living in single-family homes in the suburbs, famously. And so the demand was just suddenly much higher. And low, so we saw prices moving up very, very strongly for the last couple of years. So that changes now, and rates have moved up. We're well aware that mortgage rates have moved up a lot, and you're seeing a changing housing market. We're watching it to see what will happen. How much will it really affect residential investment? Not really sure. How much will it affect housing prices? Not really sure. It's, obviously we're watching that quite carefully. You would think over time, so there's a tremendous amount of supply in the housing market of unfinished homes. And as those come online, whereas the supply of finished homes, the inventory of finished homes that are for sale is incredibly low, historically low. So that it's still a very tight market. So prices may keep going up for a while, even in a world where rates are up. So it's a complicated situation. We watch it very carefully. I would say if you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. We need to get back to a place where supply and demand are back together, and where inflation is down low again, and mortgage rates are low again. So this will be a process whereby we do our work in a way where the housing market settles in a new place and housing availability and credit availability are at appropriate levels. So, thank you very much.
That wraps up the news conference with Chairman Powell, an eventful one. This is the Fed Decides on Bloomberg Television and Bloomberg Radio alongside Tom Keene and Lisa Bramett. I'm Jonathan Ferro. Your equity market on the S&P 500 looking a little something like this, up by more than 2% on the S&P, on the Nasdaq up by 3.2%. We were up on May 4th by 2.99%, on March 16th by 2.24%. Lisa, I'm thinking about those kind of moves because they were the previous two Fed meetings. Based on what we heard in the last hour, this is the kind of move we're getting in the equity market. Equities up, and in the bond market, yields down.
How much is this just a relief rally, just resetting a little bit after the uncertainty of what the Fed would do here? Hard to get to have any takeaway from the strength that we're seeing right now, considering the fact that you have the likes of Morgan Stanley now forecasting a 4% Fed funds rate by the end of this year, not next year, this year. And if you look at Fed funds futures, now we're looking at 3.7% Fed funds rate by February. You start looking at all of these metrics, you start wondering, Scott Minard saying that all risk assets look suspect in this. At what point does this sell-off recoup, or do we end up getting firming up here with perhaps some certainty from the Fed?
This market faded a 75 in July. Barclays straight out the gate just moments ago said 50 basis points at the next meeting. The market latched onto something really early in this news conference. Take a listen to these comments from the Fed chairman.
And I do not expect moves of this size to be common. From the perspective of today, either a 50 basis point or a 75 basis point increase seems most likely at our next meeting.
Lisa, he underplayed the idea we'll get another 75. And it was just enough, seemingly, to spark a rally in this market. Now, I want to be very careful about this. I don't want to define a news conference by an intraday move on the S&P 500 in the bond market, because we have done a tremendous amount of work in this market over the last week to add a lot of yield into the bond market and take a lot of weight, Tom, off the equity market.
Oh, yeah, the VIX comes in under 30, 28.01 right now, John. I was sort of surprised, John, at the quiescent nature of U.S. dollar. The currency market, particularly after the emotion of the emergency ECB meeting this morning, I thought it all adapted and adjusted to Powell ad lib and Powell reading off the scripts as he did often in the press conference. I thought he came out of this in one piece.
Just about. We'll get to Mike McKee in a moment, Lisa. I really want your thoughts on this. Those words from Chairman Powell. I don't expect moves of this size to be common. Went on to say, from the perspective of today, either a 50 basis point or 75 basis point increase seems most likely at our next meeting. He also talked about getting mildly restrictive by year end, 3 to say 3.5%. Your thoughts on what he said and how the market's responded to it?
I don't really understand the connection. I don't understand it, because right now what the Fed is saying is we were surprised by the data. We thought that it would help us out and get easier. It actually has moved in the wrong direction. We moved aggressively, even with that 75 basis points that we took off the table at the previous meeting, and we expect that it won't be that common. How much credibility, not credibility, that's perhaps a little bit of a loaded word, but how much credence can the market give in a Fed that is moving as quickly as the economic data, which is surprising all economists?
Should we talk to a man who was in the room, Mike McKee? I can tell you he's out of the room now. Mike McKee joins us right now. Mike, your thoughts on what you heard in that news conference?
Well, I think in some ways the chairman was admitting that the Fed had gotten it wrong and that they were going to try to do their best to change the way they approach things. Obviously, the Michigan numbers scared them. They are concerned about inflation expectations going up, and enough so that they changed their view and went to the 75 basis point, which the chairman suggested was the right thing to do, and it was also the right thing to do to give a little more guidance on that. I think what he was trying to do, in response to what Lisa was saying, is not get pinned down again, not get in a situation where they're going to have to reverse themselves. He said 50 at the last meeting and 75 was not on the table, but now they have plenty of time until July 27th to sort out where inflation is. And as he pointed out, you won't have inflation numbers coming right before a meeting this time, so it'll be a little bit easier for them. I think the biggest change here is that he now says they have to go into restrictive territory, and that was not the view at the last meeting. Last meeting was, well, we'll have to wait and see. But so now we know they're going to have to go higher, and then we know how high they think they want to go this year, and you can start to parcel out rate increases over the various meetings.
Mike McKee, thank you so much. John, we've got to do the yield curve here before we go to Bill Dudley.
And these are big moves, Tom.
The 2-year yield, 21 beeps in, 3.21% is remarkable.
If I told you 3 months ago, TK, that the Fed would come out today and talk about these kind of numbers, 3 to 3.5 by year end, mildly restrictive, 75 basis points now, maybe 50 or 75, you'd have expected a big market move. The fact of the matter is we've had one. We've had one over the last week coming into this meeting. So when you look at these moves down 20, 21 basis points at the front end of the curve, Tom, that's largely because we put so much into the front end of the curve over the last week, which is completely unresolved right now, Tom. And the journalists in the room tried to get to the chairman on this, is how he's going to respond if indeed we start to see much weaker economic data.
Yeah, well,
we still don't know the answer to that.
We don't know the answer to that. Let's do this right now. On Bloomberg Radio and Bloomberg Television, we are thrilled to bring you a guy who has a single quiet sentence in his Wikipedia. In December 2020, Dudley noted that an inflation scare was likely. We are living the scare right now, all of us, frankly, worldwide and across this nation. William Dudley Jones joins us right now with Bloomberg Opinion, and of course, the former president of the New York Fed. Here are the numbers, Bill. They lined up in the headlines, and frankly, if you were chairman of the Fed, I'm sure you would have executed this with the skill of Jerome Powell. We model 8.6 inflation right now. I guess we're migrating to 5.x inflation, and then we're on our way somehow to 2% inflation. But that will not be a smooth path. Tell us about the first inflation migration down, getting from the painful inflation now in the vicinity of 4 or 5%. How will we accomplish that?
Well, I think the Federal Reserve thinks that as we open up the economy, the demand for goods will fall and demand for services will increase, and some of the supply chain disruptions that have been pushing upward prices in goods will moderate. And we've been waiting for that for a long time. The problem is that the Ukraine-Russian war is just extending the supply disruptions. I think the Fed's forecasts are still remarkably optimistic. Inflation goes down very, very rapidly, despite the fact the Fed moves monetary policy only slightly tight. And the unemployment rate never gets much above what the Fed thinks is consistent with stable inflation. The terminal unemployment rate they have is 4.1% compared to 4% being, what they think is consistent with 2%. So I think their forecasts are becoming more realistic, but they're still unrealistic.
Okay, this is really, really important, Bill. Thank you for that comment. Is there lack of realism on the y-axis, the magnitude of the numbers, the path down, or are they unrealistic on the x-axis where, to be blunt, they think it's all going to happen quickly?
I think they're probably too optimistic about, one, how fast it comes down. But I think the second thing they're too optimistic about is what is necessary to generate enough slack in the labor market to bring inflation back down to 2%. This is a very soft landing kind of forecast. A soft landing kind of forecast without the Federal Reserve actually having to move to a particularly tight monetary policy setting. The Fed keeps talking about neutral being 2.4%, but 2.4% neutral is only if inflation's at 2%. If inflation's higher, then neutral's higher. And so I think the forecast is still remarkably optimistic.
Bill, you're touching on something so important. Carry on.
This is basically the best case forecast. The best case forecast is their model forecast. This is possible, but it's not where I would think that I would think this is not very likely.
Mildly restrictive. He said it's 3 to 3.5. Now, restrictive territory is not what the Fed chairman says it is. Bill, what do you think it is? He's saying it's 3 to 3.5 by year end. Is that mildly restrictive from where you're sitting?
It depends on what's happening to inflation and inflation expectations. If inflation's high and inflation expectations are a little bit elevated, then neutral's higher. And there's also this whole idea that we're running off the balance sheet, and so that's substitutes for monetary policy tightening. The balance sheet is still very, very large. The balance sheet is still in an accommodative setting. It's going to take 3 years for the balance sheet to get to neutral. So people are basically convincing themselves the Fed doesn't have to do much because the balance sheet runoff is going to do the Fed's job for them. So look, it's possible that things could work out this way, but I think highly unlikely. We've never had a situation where the unemployment rate has risen 0.5% or more without a full-blown recession. So the Fed's forecast is basically saying that they're going to pull off something that's never been accomplished in U.S. economic history.
Bill, based on the change in data that the Fed was focusing on, do you think that we have to go well above your former projections of 4 or 5%? Because you have been out ahead in terms of how much different this cycle could be than the past few.
I think I would stick for that for the time being. I mean, the good news, as Chairman Powell talked about, is inflation expectations still seem relatively well anchored. Obviously, that's what provoked the 75 basis points move. I don't think it was so much just the headline CPI. I think it was the fact that they were seeing signs of inflation expectations starting to become a little bit more suspect.
But are you saying that we're going to be glued to our Bloomberg terminals for you, Mitch, and the New York Fed inflation expectations? Print that we get?
Well, I think it's more important because the longer inflation stays above 2%, the more risk that inflation expectations start to become unanchored.
Fascinating stuff, Tom. For anyone who's following,
extraordinarily important.
You, Mitch, the next date in the diary is June 24th, which apparently has taken on this whole new meaning since the chairman talked about it in such a way in the news conference.
Bill Dudley, you wrote in a book for me years ago, there's not a moment to lose. And obviously the Fed delayed here, and in 2020 hindsight, there were some real challenges. What is the Dudley prescription now for the Fed to get the credibility back and to manage the message more efficiently rather than having the bond market be the chairman of the Fed? How do they get back to messaging when what Lisa, 14 people are going to speak in 10 days? I mean, Bill Dudley, how do they take back the message?
Well, I think the thing that's still bothering me a bit is that they're still telling a very benign story, when in fact I think there's actually going to be some real pain. The forecast that they have is a soft landing. The unemployment rate goes up a little bit, not very much. And it all works out pretty nicely. I think the risk is that the Fed's going to have to cause more pain, and I think it'd be better for the Fed to be more forthcoming about that. Because if it turns out that it's going to take quite a bit of pain, the Fed's going to lose a lot of standing if it turns out to be more difficult than they're saying. They're also putting a lot of the responsibility not on themselves but on external developments, the war in Ukraine.
Right.
I think the Fed has to take the world as it is and do the job that's required to get inflation back to 2%. I agree that the job is harder now. But some of that is the Fed's doing, not just external events.
Dr. Dudley, thank you so much for writing for Bloomberg Opinion and joining Bloomberg Surveillance in our Fed Decides effort as you can. Bill Dudley, the former president of the New York Federal Reserve System. Taking notes, Jeffrey Rosenberg joins us from BlackRock. Jeff, what will you adjust across your portfolios here in the coming days off of what we've observed in the last 2 hours?
Yeah, thanks, Tom. Just to echo what we just heard, this is, a big change from the Fed in going from, magical thinking in terms of their earlier projections to a little bit more realism. But the challenge really lies ahead. What the chairman laid out was this expectation that their forecasts are going to be met. You're going to face a period of validating the decline in inflation and then slowing the pace of policy rate increases. And I think that's a little bit, Jonathan was highlighting in terms of, we priced in a lot. And you're getting a little bit of relief here because the Fed chairman talked a lot about, we're getting there pretty soon. So, to your question, Tom, I think that's setting us up for a very built-in set of expectations that the Fed is going to be successful on these inflation forecasts. And as Bill Dudley just highlighted, getting to neutral it presumes that your inflation forecast is doing a lot of that work. And you're not going to be at mildly restrictive if that inflation forecast doesn't come down. At the same time, what we face is it's going to look and feel very different for the Fed and for the market and expectations to be talking about what is the Fed going to do when you're faced with the implication of what those unemployment forecasts are really talking about. That's a dramatic slowing in these headline payroll figures, and to the extent that you may be looking at negative prints on that unemployment rate, and that's going to feel very different for the Fed. And there was a question that was asked, how are you going to balance the trade-off between the growth and the inflation side? And that's really where I think for the investment implication is going to be the critical issue. Does the Fed get to that level of trade-off where they can pause according to what they're projecting here? And if they can, then you might see a little bit more relief. And if they don't, then it's much more about pressing on what they said they were going to do today, that inflation is number one, and it raises the recession odds much more significantly.
Jeff, based on that, and I think it's such an important point that when they're actually faced with those negative jobs numbers, will they be able to say that their inflation really is their primary objective and that they are going to do whatever they take to bring it down? Would you fade the rally? Do you basically reject the knee-jerk reaction in today's markets to this statement? Obviously, just one day does not a trend make. Or do you think that the market sees something that the Fed does not, or that the Fed is basically signaling in terms of their patience and their ability to pivot quickly?
Yeah, back to something Jonathan said. We don't want to characterize the meeting by the intraday market moves. And we've done a lot. We've priced in a tremendous amount of increases, and we've reflected some of the change that the chairman just described. But what Bill Dudley highlighted is that, the market's pricing in this kind of consensus view, aligning with what the Fed SEP is saying, doesn't necessarily mean that that's where we're going to end up. And I think to the investment implication, that's the more cautionary read here, is that, if this isn't the base case, but this is actually the best case, then what Dudley and Furman and Summers and others of that camp are highlighting, which is the alternative, more bearish view, is that there's a lot more work that has to be done, and that the Fed is still significantly underestimating the degree of tightening that's required, and therefore the impact on financial conditions tightening, and that we have to be cautious about jumping to conclusions here that because the Fed says it's going to get these forecasts, that's actually going to play out, and we're going to have to really be a little bit more cautious as we see those trade-offs play out.
You're trying to be open-minded about so much of this. Jeff, it's great to catch up as always, sir. BlackRock's Jeff Rosenberg there. If you're tuning in, here's your market move. We're up by 1.7% on the S&P 500, picking things up going into the close. Let's catch up with Romain. Hey, Romain.
Hey, John, and of course that 1.7% move, if that holds into the close, this is actually going to be one of the biggest daily gains that we've seen on the S&P since the last Fed meeting back on May 4th. But of course, we know what happened after that, a big sell-off the day following that, and followed by several days of weakness here. Right now, there does appear to be a little bit of conviction in the trade, particularly when it comes to a lot of those discretionary names, particularly the ones that have beaten down, the Chipotles, the Netflixes, the Tapestries of the world, all moving higher and helping to lead most of the major indices higher along with it. Bank stocks also getting into action. Citigroup, representative of that, up about 4% here on the day. KBW Bank Index up more than 2%. Your biggest laggards, well, you're going to find it in some of those economically sensitive areas that a lot of people had sort of gravitated to, those defensive areas, the auto zones of the world, the Dollar Trees, and of course those energy stocks. Of the 20 biggest percent decliners right now in the S&P 500, 18 of them are tied to the oil, gas, or chemical space. So keep an eye on that space, because it all boils down to not just so much the grandiose nature of the rate hike that we got today and the one that we may get at the next meeting, but really the duration of it. How short is it going to be? And do you believe in some of the commentary we heard out of J Pow today with regards to the conditions, the economic conditions, and how strong they are? As far as Bitcoin and some of those alternative assets out there, well, that decoupling continues. Remember, we're talking about a correlation between Bitcoin and the rest of the broader market. That had swelled to about 0.8 just about 4 weeks ago. That's back down to about 0.5 here. The decoupling there, and you're going to start to see a little bit of shift. A lot to talk about coming up here on Bloomberg Markets to Close. A lot of great guests coming up, John.
Romain, looking forward to it. As always, buddy. Thank you, sir. Elisa, I think the lesson from the last meeting, try and be somewhat humble. Try to be. Given the moves we're seeing today up by 1.7%, just a reminder, the following day after May 4th, we were down by 3.56%. I don't think anyone thought at the last meeting that, Lisa, we would be here today at this meeting looking at 75, talking about 3 to 3.5 by year end. Not many people saw that coming.
And not many people also saw the data and just the fact that we would see more acceleration. Kathy Jones said basically the Fed is saying it is willing to risk a recession to get inflation under control. That's the big message and the big takeaway of today.
I'd suggest it's problematic, Tom, to extrapolate out too much of what we've heard today through the rest of this year.
I'll extrapolate. This is an historic meeting. We got lots to talk about tomorrow. John, in the next Fed meeting, can I get fresh tang?
Is that what you're upset about?
Is
that from this morning?
It's from this morning. It's got like a thing floating.
You're so needy, TK. You're so needy. You get some raced. Tom Keene, Lisa Bramis, and Jonathan Ferro. Your equity market up 1.7% on the S&P 500. This is Bloomberg.
All right, so that was some good action right there, and seeing that live with some of these indicators, I hope that was a helpful little exercise. Looking at some financial media going on during a period of trend and higher volatility. So we're going into this close here, 3:45 p.m., June 15th, 75 basis points, Fed hike. That came out official just a couple hours ago. We got the Fed press conference as well. I hope that was kind of eye-opening to see kind of how the the math that BApig provides, and in relation to some Fed chairman named Jay Powell, just answering questions, and I mean that's not I don't trade like that. BApig doesn't really promote trading like that based off of narrative or whatever, because at the end of the day, something intuitively bearish for risk assets happened today. Something bearish, 75 basis points, and the market's rallied. But realistically, the market is forward-looking. If you want to look at these futures right here, these 30-day Fed funds futures, which is a great proxy, and this was being priced in actively last Friday, June 10th. So being forward-looking, and we did see Nasdaq having some negative returns during that yield increase on the Fed funds rate, a Fed funds increase. So looking at that and then putting into perspective of today and that rally again, we're seeing that volatility expansion happening in real time, and being able to make decisions based off of that during times like that. I don't know how useful kind of even having that press conference on is really. I mean, I guess he did say that. Well, Powell did say that he doesn't plan on using 75 bips again, and that, but it's all narrative really at the end of the day. That really isn't important. You want to look at things, entropy right here. Entropy was really high during that stretch, so that's telling me that the randomness of returns is going to be high, and we saw that with some negative returns and then some positive returns, just kind of that wick down to the wick high. So that right there was telling me that if there's some volatility, that there's going to be high amounts of randomness in it, and So also looking at the mean was positive already, right here, you know. So to take a long trade, maybe you look at the similarity of returns right here, similarity increasing. So when you have a similarity increase, thinking about variation and probability, those are some things to definitely look at. Volatility still low, and it was interesting to see that in real time, and then also probability too. Like these aren't just dots on a chart. These are probability calculations based on the expected move of different assets. So looking at that, I mean, you saw that wick up to the 2.5% probability on the 2-day. So having a multi-time frame type of probability, and take this into context with where we are, where the Nasdaq 100 is, where Bitcoin is, that we're in these black swan type of areas in terms of quarterly. We're at the 2.5% probability, so there's a 2.5% probability that Bitcoin and the Nasdaq are going to close here. Very low probabilities. And like I said, I mean, the difference between a 3 standard deviation move and a 2 standard deviation move is insane. It's not just a magnitude of it's much different because you're dealing with decimals, right? You're talking about a 0.003% probability and a 0.1 or a 0.25% probability. So yeah, they're massive, and that not. I mean, it's not to say that it can't be a real extreme black swan where it is going out to these extreme probabilities, but we're already at extreme probabilities. You can look at this on the mean pro, right, on the 2-hour right here. Yes, we're negative. So if you look at the expected value over the 1,000 candles, yes, it is negative. But that doesn't mean that the extreme negative values is going to persist. or that there isn't going to be some type of normalization in the mean of returns. It's so when people ask me, oh, is like, what's your take on central bank policy and stuff like that, that's more so just to kind of keep myself preoccupied during trades and things like that. It's more so about the math and the statistics really. Sorry about that. But you look at the mean and things like that. It's not something more. I mean, it doesn't have to be anything more than that, really. Like, I know I put up a bunch of indicators and things like that, but it's days like today are outliers, really outliers. Like, you don't really get a lot of them, but it doesn't change. It doesn't really change the math behind these distributions and the returns. We're just being able to visualize the randomness and be able to form assumptions and make educated guesses on their future values based on their distributions, and looking at tendencies in their distributions and things like that. It's not looking for trends and stuff like that. If I want to know if it's trending, then I'm going to look at the Hurst exponent. And so that's why, like, oh yeah, right now it is a good time to trade because you're going to get large returns. There's a higher probability of outsized returns. And you can look at SSR and things like that. But yeah, so pretty crazy day with that. I mean, it was pretty similar to back in May, where you did see that rally. So that May 4th rally. If we want to go back, we can check that out. But let's just see where yeah. So we're going back to May 4th right here, and this is May 4th right here, where the last Fed meeting was. It was a massive rally, and you did see some variation associated with some positive returns. But the tendencies of variation being associated with negative returns continued. So that's kind of like the geometric Brownian behavior of returns. That's why people say it's GBM. It's like a gas particle floating in space. It really just moves around and oscillates, and then there are tendencies of the distribution, but you're going to need multiple occurrences to be able to to make sure that hypothesis isn't just isn't unfounded, but yeah, it's a. So what I did during that press conference was I actually opened up a put spread on the triple Q. I got into a long on Bitcoin yesterday, so opened up a put spread, bought a put, sold a put further out of the money. I'm down like $40 on that, but it gives me opportunity to be able to, okay, well, now I can close out of the short put. When the press conference started, the short put, I got a credit for $509, and right now it's trading at $400. So that's like a $100 gain on that short put. But then you have the long put side of things where I paid $675 for it, and it's marking at $533. So that difference right there is about $30 in between the long put and the short put. But I still have options though. So I mean, with that, I can close out of that first leg of the spread, leg out of the trade, and hopefully the triple Qs are lower than 280, 290 come tomorrow. That adds risk to my position and stuff like that, but it's something that I'm thinking about for sure. But yeah, another FOMC press conference. I think that this one was really kind of a little bit of a again another press conference that really has little meaning to market to the entire market, and spending time on it is just more so just to be in tune with things and to be able to catch up on it. But the 75 basis points, it seems like that was already priced in, quote unquote. But yeah, this is kind of getting into some of the more larger markets in finance, like the ones that are the real engine behind the car in terms of the entire market. But each market is its own market, and there are factors that influence different markets. But to say that the Fed was going to hike by 75 basis points today and that there's going to be a large rally, I don't know. I don't really know where people and like what market are people probably trading? The NASDAQ, the S&P, the Dow, maybe the Russell. All right, so they're gonna be trading some large equity indexes probably, just due to liquidity and diversification. So you're talking about a Fed funds market for banks and bank reserves, I guess, and equity indexes. I mean, that mutual information, that correlation is probably pretty low. And today, I mean, with everything, the reason why the NASDAQ was up at 1.3.5%, 4%, well, maybe it was due to the fact that the mean of returns was outside of its first standard deviation. Maybe it was the fact that the NASDAQ is at its 2.5% probability on the quarterly. More so than it was that Fed Chair Powell said some words and is historically really far off the nail. But that's what we do over here with BApig. And thanks a lot for joining. And hope you guys are going to be coming back for some more content, and we can kind of collaborate and bring this to the next level. Thanks a lot, guys. Until next time.